How's everybody doing? Studying going well, hopefully. Midterm scores look pretty sharp. Pretty proud of you guys. Looking like you're getting the hang of it. If you have some questions about it, let me know. We'll talk about it. I'm pulling that up as we speak. And we will get to the bottom of those things. Okay, there we go. So let me know in the chat particular midterm questions you might have. There we go. Double check that that's the, I think there's only one version. Let me double check. Okay, yeah, should be the right one. So if you, as you're going through and thinking about it, look through what you did. We'll just kind of go through them a little bit. There we go. Okay. We've been talking about finance. I think we're pretty close to being finished with that one. And next up, if I can find it. Yeah, closing the sale transactions, procedures, closing procedures. That's chapter 21. So we'll be getting into that really soon. And that's another one that's pretty sharp, pretty important, both in real life and for this test. It's going to be a 2-evening commitment. Then we've got valuation, and then the rest of them after that, as you see, a little 1 to 2 hour ones, maybe even half-hour ones. So about to get into a whole bunch of various topics all in a row. So hopefully you're reading ahead. That's going to be your best friend. The syllabus, reading ahead. But let's start here. And oh shoot, you know what? Well, it's okay. All the following are examples of appurtenances except what? Any mystery there? Any problem there? What is an appurtenance? Tell me in the chat, what is an appurtenance? Or you can speak up. That's fine. There you go. Yeah, it's a right or privilege that runs with the land. And that could encompass lots of different things. What sorts of things could be in appurtenances? There's one that comes to mind right off the bat. As to how you might access their property. If you were landlocked, you didn't have direct access to that public main road or some sort of road. Yeah, there we go. A driveway easement. Classic example, and we'd call that an easement appurtenance. So other appurtenances, as we see here, because the question is which one is not, and hopefully you're getting a hang for that, because honestly, that's what gets me. When I end up getting something wrong, it's because I forgot to look for the exception. I'm starting to look for the one that is true, but it's the only one that's not true. And if that's something you suffer with, then my suggestion is to use a piece of scratch paper and draw them out, write it out, 1A, B, C, D, and just go through and think, okay, which of these are actually true, and mark a little T or F, true or false. Then go back through and say, okay, what's the question asking me for? Oh, the thing that's an exception, then I want the false one out of this list. Whatever helps you deal with your fatigued brain in that moment, because you're going to be fatigued. We know this much. The first hour, you'll probably be pretty sharp. Then it kind of wears on you, and when those tough ones flip around on you and you have a mental fatigue going on, it's whatever you can do to keep your thoughts straight. So easements are appurtenances. Restrictive covenants run with the land. Whoever you sell it to has to follow those rules too, just like you did. And riparian rights. What are we talking about when we say riparian rights? What's that dealing with? Riparian rights. Water rights. Yeah, and what specific kind of water is riparian? You got it. You got it. Rivers, lakes, streams. There's one specific kind of water that it is not. Riparian is all kinds of water that do not have what sort of weird moon-based activity. Witchcraft. Just kidding. Tides, tidal waters. Literal rights are dealing with tidal waters. Riparian rights are non-tidal waters, right? Rivers, lakes, streams. Let me, I got a couple on the list here. Let's skip around. We'll go to 44, 46, and 49. Barbara Broker of ABC Realty has a client, Barry. Uh-oh, I lost my Zoom capability. I don't like that. Has a client, Barry, who's interested in a home listed by Angie, agent of ABC Realty. So what do we know so far? What kind of sale is this? Barbara Broker of ABC Realty has a buyer for a home listed by Angie, agent of ABC Realty. We're not dealing with a co-brokerage situation. We're dealing with an in-house situation. Makes me think that maybe dual agency might be a thing, but maybe not. We'll see. So it's same firm so far. Barry makes an offer in front of Barbara. She faxes it, whatever that means, to Angie at 6 p.m. on Monday. Angie's seller client counters the offer. So at what point in this point of time, the seller has countered? What do we have on the table? What do we have going on currently? Yeah, a rejection and a counter. So now if the seller changed her mind and said, you know what, never mind, I'll go back to the one you originally made the offer for. That's not for her to say. It's out of her hands now. She can't just sign it real quick and be back on track. She's going to have to wait, hope that the buyer will agree to resubmit and go back to that original plan. So right now we're in a counter offer, which is first and foremost a rejection situation. So seller client counters the offer. Angie faxes the counter back to Barbara at 9 a.m. on Tuesday. Barbara immediately goes to Barry with the counter, and he accepts it in Barbara's presence. When they say in Barbara's presence, what are we accomplishing right there? What sort of step in the process are we accomplishing? If the buyer has signed in front of his own buyer agent while she's watching, then the communication is happening in that moment. We don't have to worry about a phone call or an email or a text. It's been communicated because she watched him sign it. So look for that in the test question. That's why they write it that way. The communication is accomplished. However, it's not the communication that really counts, is it? It's on the same side of the tennis court so far. Communication has happened, but not the kind that makes it a contract yet. So she's watching him sign it. He signs it. She attempts to contact Angie, who she is out of town until Friday. Barry later in the day has second thoughts regarding the transaction and tells Barbara, don't deliver the acceptance. Which of the following is most correct? Could Barry rescind the offer at any time prior to notification of Angie? So keep in mind here, you might be thinking, well, the communication was attempted to cross the tennis net, but it didn't happen yet. So why don't we have communication that counts? Or why do we have communication that counts? Because the right answer here says the Barry can't rescind the offer because he's put himself under contract. He signed in Barbara's presence. Barbara works for the same firm. So that's the twist. If they were in different co-brokerage arrangement, different firms, then yeah, we would not have a contract yet, but we do. Does that make sense? Because it's the same firm. Essentially it has been communicated because while it wasn't communicated to Angie, it didn't matter. It was communicated to Barbara because she witnessed the signing and they are both in the same firm. That's what just took place. I know. Right. No, I get it. I get it. It's no, I get it. I know it's easy to mix up. Is it the same firm or is it two different firms? It's the same firm. Now, I would rather this question have addressed the concept of dual agency and designated dual, right? But that's the point they're trying to make with the question. It is in the same firm, and that's what gets tricky out there in the real world. It's why it can get awkward, right? Everybody needs to give permission for dual. And the firm, don't forget the firm is the agent. We've got two representatives of the agent involved, but the agent is the one who was told. Which agent? Well, now the agent for both sides knows because the agent for either of the side knows. Because it's only one here. Because the agent is only one firm. It's an in-house sale. Telling one is the same as communicating to the other in this very specific case because it's an in-house same firm, therefore the same agent sale. To draw a weird analogy that just occurred to me, anybody ever seen the conjoined twins? I'm thinking of the little girls from like a few years ago. They're like joined at the torso and they have two different heads. They have two different lower bodies and each has an arm that they control. It's like a literal conjoined twin situation. Can you tell one without the other knowing? Well, they have individual brains. So I guess if you could let one read it or not, that might not be a good example, but same entity. And that is that single firm, right? The firm is the agent. This is where that matters the most in the course. Go back to the basics of the course. In real life, I mean, this could easily be something that happens, but we get so caught up in saying the agent as the human. But this is where you got to remember the agent ultimately is the firm. And does the agent know that the offer was accepted? Yes, because one sub-agent of the agent, Barbara, watched the guy sign it. It was communicated. And so now the agent, which is the firm, knows. Barbara knows on behalf of the firm, even though Angie doesn't yet know. But they both work for the same agent because they both work for the same firm. I'm not sure you'll see one like this. I feel like it might be a little more dialed in on the real exam. I'm hoping for you. But you do need to really go back to basics and think firm is the agent. So Just let that seep in a little bit, sink in a little bit. And ultimately, yeah, good question. Doesn't it need to still be communicated to the buyer? Well, what do we have here? Do we have a buyer's agent or a sub-agent to seller? Well, it says Barry buyer and Barbara broker. Okay, the client. That's the word you're looking for. Her client. So therefore, it's a buyer agency agreement. And so therefore, telling the agent is the same as telling the client. So no, we don't need to tell the client specifically. Telling the agent is enough. It's just that weird part about, well, what is the agent? The agent is, gosh, how'd that thing come up there? The firm. And so telling one member of the firm is the same as telling the other one. Yeah. Right. Yeah. So that's where your explanation of how all this stuff works with regard to agency is so important, because it could come back on you if they are surprised by all this. You got to let them know how all this stuff could go down. Barry, he made the offer, he made a counter, he just changed his mind. But there is a point in time, whether co-brokerage or in-house, that it's too late to change it. So that's just a reality of the way the transaction could go. It just happens to have been at this point in time. So that could, if Barry didn't like this and was mad about it and complained to the commission, did the agents involved explain, his own agent, Barbara, explain to him how all this stuff worked well enough? And sadly, a lot of times, probably not. $46. Elderly couple from California wants to move to Chapel Hill. Really don't know why this thing did that. Okay, good. Went away. Elderly couple from California plans to move to Chapel Hill to retire. On a recent visit, they signed an exclusive buyer agency agreement with Betty Broker at ABC Realty. They find a house that they like. So she is their buyer's agent. Betty fills out the offer. The couple wants to think about it on the flight back. In California, the couple signs the offer and mails it to Betty. Do we have a contract? They've signed it. We don't know enough yet, do we? Now you're gun shy. You're like, I don't know. Where's the other agent? Who do they work for? Couple signs it and mails it to Betty. Betty receives the offer and presents it to listing agent Tammy of Chapel Hill Realty. Do we have a contract yet? No, we just have an offer. All they've done is made an offer so far. Tammy's seller client counters in Tammy's presence. So communication has happened from seller to Tammy because she watched him sign it, but it's still not back across the fence. Tammy hand delivers the counter to Betty. Okay. Betty mails the counter to her clients, who sign acceptance of that counter and mail it back to Betty via certified mail at 3:30 on May 7th. At 4:15 p.m. on the 8th, sellers receive a better offer, and the sellers inform Tammy that they would like to rescind the counter offer and accept the new offer. What do we have going on here? Which of the following is most correct? Obviously, you see sellers can rescind because communication has not occurred from one side of the fence to the other. Questions? Mails the counter to her clients who sign the acceptance, and they mail it back to Betty exactly 3:30 on May 7th. 4:15 p.m. on 5/8, sellers receive a better offer. So it was mailed back to their own agent. The only thing that's happened is one side has told the same side. She has not yet told the other side, in this case, the other agent, whatever her name was, Tammy. Right. Yep. Yeah. I know. Yeah. Exactly. And then they get into this stuff about via or certified mail exactly at blah, and then it adds another level. But you could even just solve it or maybe help it with a drawing like I do. Buyer side, seller side, fence down the middle, and then just say, okay, this went over here. What has happened over here? They told their person, are you seeing my hand? And then they went back across. You could do that whole thing. Kind of get it straight. That's the sort of thing that messes me up too. You're welcome. 69. I think that was the last one. Nope. Which of the following statements is true? An agent may be compensated by a third party with conflicting interests of the agent's client. Oh boy, here's one of those. So, can you get paid by a third party whose interests are conflicting from your own client? What do you have to have? Better question maybe, what do you have to have in order to be able to be paid? There you go. So we get so caught up in the, no, that's bad, that we think, no, it can't happen, but it can happen. Here's another question like that. Can a listing agent tell an offeror or a buyer agent what the highest offer on the table is? Can a listing agent tell everybody what the highest offer on the table is? There's like, yeah, exactly. If you have the very unlikely permission, you're not going to ever have it, by the way. It's almost impossible anybody would be that dumb. But yes, they could if they have the permission from the one who made the highest offer, right? So don't let that sort of thing fool you. Just because it's a stupid thing to do doesn't mean it's not possible to be done and even allowable to be done. So it's all about client's permission. Let's look at the other ones to get some mileage out of these. The source of compensation is always an indicator of agency representation. We know that's not true. We could owe all of Old Car to our buyer, but we're the buyer agent getting paid via the seller, basically. And so even though the seller is the originator of our pay, because they're sharing it with their agent, and their agent's sharing it or giving it to their agent, and their agent is sharing it with us, that doesn't matter. We still owe more to our own client, who's on the opposite side. Representation must be confirmed in writing before first substantial contact. Well, that would be nice, but it's not required. In fact, a lot of times you can give them the explanation of agency with the working with agents disclosure, and they won't sign representation, and you have to make a business decision. Am I still going to show them these houses? And a lot of times you go ahead and show them these houses because you just need a little more time to win them over. And that's for your, first of all, firm to say a policy and let you know, do we do it this way? And they probably do give you some leeway about that. Eventually that BIC might say, it's about time to really call them out, force their hand and say, what are you going to do here? Because they might be wasting your time. People will let you show them as many houses as you're willing to show them without any obligation to see that you get paid. So you got to be careful. I've heard stories of just people who are lonely with nothing else to do, and they call some agent because they know a lot of agents will drop everything and just die to go show them something. And I've even heard of a crazy one where the lady talked him into taking her by the store so she could pick up some groceries, and then went back and was this total manipulation of that agent's willingness to do whatever it took. And it was complete waste because the person never even had an intention to go through with anything. There are 4 classes of agency: universal, general, independent, and special. Well, 3 of those are true. There are 3 general classes of agency. Independent is not one of them. So let's see, what else was it? Got a couple of requests for 71. Let's take a look. Kristen reviews the working with agents disclosure with her clients, the Browns. They've chosen to not yet sign buyer agency, like we were just talking about. While out showing the properties, the Browns have asked to view a property listed by another agent in Kristen's firm. She explains again about dual agency and how all that works, and the Browns say, okay, whatever, just show us the house. Which of the following statements is true? Before showing the property, Kristen should confirm the sellers have authorized her firm to act as dual agents. That's an extra step than we usually have to deal with. But that's what dual agency is all about. Just because the buyers are okay with it doesn't mean the sellers are okay with it. So you better not show that house if the sellers have already said, nope, not interested. How is she going to find this out, by the way? How can she verify what the seller's wishes are for dual agency? That's a great idea. Yeah. I was waiting for somebody to say, look in the file cabinet back at the office. And while that might actually be a way to accomplish it, if an office is being run properly, that's not an option. They should keep those locked, because if it does turn into dual and designated agency, dual, not a big deal because you're on the same side of the fence. But if it turns into designated agency, yeah, you better keep those files confidential. You don't want two different designated agents in a transaction seeing the files of the opposite side. That firm could end up being in trouble. Kristen may not show any properties listed with her firm until the Browns agree to dual agency in writing. Well, that's not true. They don't have to agree to dual agency in writing. Why not? If they haven't agreed to buyer agency in writing, which is legal and allowed, they don't have to agree to dual agency in writing. But does that mean you should not bother to mention dual agency? Or do you still need to have the conversation? If the buyers have not agreed, or if the buyers haven't even been talked to about dual agency, that's a problem. It needs to be an express conversation. Express doesn't mean in writing only. It could be verbal, oral. So when you do oral buyer agency, you need to also talk to them about dual agency. And then when you take it to the next level, hopefully before the offer is written, and convert that to written buyer agency, say, remember that thing about dual agency? Okay, well, here's where you're signing that you're okay with that, if that's what the plan is. Browns must agree to designated dual before Kristen can show the property. Well, that's not true. Not necessarily. If that's what everybody's willing to do, then sure. But in this case, no, it's premature. We don't have to do that yet. Seller's agency agreement should be amended to add the Brown signatures to authorize dual agency. No, we don't do anything with the buyer on the seller's agency agreement. The agency agreement is just between the seller and the firm. The buyer agency agreement is between the buyer and the firm. Neither party gives any sort of permission on the opposite party's agency agreement. I got a 22. Keep putting them in there if you think of one. I'll end up pretty much going over most of them. I'll scan back through and see if there's something that looks particularly confusing. A house has a finished basement below the garage. That's weird. I don't know how that works. You don't usually have basements below garages where cars are parked, but anyway. Accessed externally from the backyard. The owners use an electric portable heating unit to heat the basement during the winter. Which of the following is true? What does something have to have in order for it to be included in the heated living area? It's got to be heated. It also has to be what? What do you remember from the yellow book? Heated, finished living area. Finished meaning drywall, paint, flooring. Can't just be the studs showing. Got to have those covered up. It's got to be livable, living space. So, finished basement below the garage. That's good. It's finished. Accessed externally from the backyard. Oops. That's the other one. in order to be included in the main heated living area, it needs to be accessible from the rest of the living area, right? So what we might be more used to seeing than this situation is a 2-story house, room over the garage. And let me give you one of my Michelangelo specialties here. We've got a 2-story house. There it is. There's a little front door. Here's the garage space, bigger door. And here's this. If you went upstairs in this house and came over to here, you'd run into a wall and break your nose because there is no accessibility between this space and the rest of the heated living area. To get to this space, you'd have to go back down, out to the garage, up those steps separately. So this is its own thing. It's sort of like this, oops, that didn't work, is its own bit, and then the rest of it is the heated living area. So while this is heated and finished, it would have to be listed separately. You'd have to, in the MLS, say, this is an extra 500. Yeah, that's good. Be a good Airbnb room. An extra 500 feet of heated living area, but you can't add it to the 25 of this part. So, best answer, basement does not meet the criteria for heated living area due to not being adequately heated. Oh, that was another thing. Let's see. Oh, electric portable heating unit. Right. That's the reason for this, the answer of this question, because I didn't read far enough. It's got to be permanent heat, like a main permanent heat source. Can the basement be included? No. For that reason and because of the access externally. Basement can meet criteria to be included as living area if a permanent heat source is added. No, because it's accessed externally. It would need to be something blown through a wall to access it from the other heat source. You with me? Basement does not meet criteria for living area because it's below the garage. That's irrelevant, even though it's foolish because, again, cars are heavy. 22. Is that what we just did? Yep. We've got, let's hit 10 and 13 while we're down here. We'll do the math ones in a minute. Okay, good. Those are both math. Let's go to 46, 48, and 56. We did 46 already. Are we okay with 46, or do you have questions about that one? Okay, good. 48. Which of the following is true regarding the backup contract addendum? What are we talking about with the backup contract addendum? What's it good for? Absolutely nothing. No, that's a quote from an old song about war. Backup contract addendum is for when you want to have an automatic second place because something is already under contract. And if that seller will agree, what's the benefit of this to the seller? Well, they have an automatic plan B. What's the benefit to you? Then you won't lose it again if the first one falls apart. How often do offers and contracts fall apart? Not that uncommon. It happens for a variety of reasons. Could be the repairs weren't agreed to and the buyer decided there were too many of them for them to want to deal with, and they were willing to walk away from their due diligence money. In this case, what's true? Buyer in a backup contract may terminate the contract without liability at any time prior to being notified that they've become the primary buyer. Do we get what that means? They haven't. Go ahead. There you go. There you go. Yep. Yes, that's what I do. Okay, good. You're welcome. Yeah, so just when you see backup contract, think second place buyer, buyer 2, or buyer B. Seller can dispense of the primary contract without obligation if the backup is better. No, that's not how that works. The seller could hope that the first one falls apart because the backup one turned out to be better, And by the way, the seller could kind of sabotage it. If that first primary buyer said, I want you to fix $10,000 worth of things, and the seller is confident because they know you are the backup buyer and they like you better, think they're going to be a little less likely to be willing to fix those things or give money, you bet. They're going to basically say, I'm not fixing anything. You want to leave? Please go, because I got one I'd rather take. So that's okay and allowable. They could choose to be, it's sort of the same idea as these multiple offers. Sellers have been a lot less likely and willing to fix things because they know probably going to get another offer if this one falls apart. The backup contract gives the holder the right to negotiate once the primary one falls through. You go ahead and negotiate them up front. That part's done. When you become the backup offer, or it's not a backup offer, it's a backup contract. You've already negotiated it, right? So that part is not a renegotiation later. Earnest money will be paid only if the backup becomes primary. The earnest money gets paid out. The due diligence does not. While you're in the backup position, you don't have to give due diligence money, but you do have to go ahead and give earnest money. And then once you rise to that primary position, now you've got to hurry up and provide the earnest money according to the normal time frame. 56. Okay, good. Another math, and good. That's 3 math. We'll work on those. Property sells for $650,000, has a width of 125 feet and a depth of 400 feet. What is the cost per front foot? What are we looking for when we're dealing with this square footage, front footage thing? What is square feet? Or how do we get the square feet of this lot? How do we? That's right. This, you could call it the street footage, that kind of thing. Yeah, so to get the square feet, it's just going to be the dimensions multiplied by each other. But they're not asking for square feet. They're asking for just the feet across the front. Front feet, rethink it in your brain to feet across the front. Just that first of the two measurements. 125 is the front footage. And so if it sells for $650,000, has a width of these dimensions, what's the cost per front foot? Then that's going to be however much it sold for divided by the number of front feet. It sold for $650, and we're just going to divide it by the number of front feet. If they had said, what's the cost per square foot or cost per acreage, we would have needed to use that square footage number. But since the only thing they wanted to know is what's the value per the front foot, it's just $650 divided by the 125. In this case, 5,200. And since it could very well be a question that they ask, let's figure out what it would be cost per acre. In order to get acres, if all they give us are dimensions, we need to work with square feet at some point. So what's the square footage of this lot? 400 times 125. I get 50,000 square feet. Is that what you get? Now, what do we do to this square footage of this lot in order to figure out the number of acres? We need to multiply it by something. Or sorry, divide it by something. And we're going to divide it by the number of square feet in an acre. The 4 little old ladies. There you go. Divided by the 43560. That is 1.1, we'll call it 5 acres. Now that we know the number of acres, we can divide that same 650 by the number of acres. And that tells us that this lot is worth $433,333 per acre. What if they'd ask us, what is it worth per square foot? Do we know the square feet? Yeah. Then we're just going to say 650,000 divided by the 50,000 square feet. In which case it's $13 per square foot. $13 times 50,000 square feet. There it is. You can always check your work back. If it's like not clicking in your brain, you didn't expect to see a little 2-digit number. But what I see on the practice test at least are either price per square foot or price per front foot. It's either going to be this one, price per acre or price per front foot. I don't see per square foot too much. Does that help? What else? 10 and 13. Okay. Gotcha. We'll do 10 and 13, go back to 9. The house is under contract for $235 with a 7% total commission. Listing company has agreed to pay 4% to a buyer's agent. Jim is the buyer agent with ABC Realty and has a 50-50 split with his firm. How much will Jim make once the property closes? When it says pay 4% to a buyer agent, what are they talking about? Jim or ABC Realty? Yeah, another time where you got to really keep track of the agent word. Okay, no, they are asking how much will Jim make. That is what they're asking. But to keep track of the numbers and figure out what percentage we really need to know, just keep track of that entity called an agent. So what do we have? Let's make our little commission tree. We know it's selling for $235 at 7% commission. $235 times 7% means a total commission dollar amount of $16,450. That's total commission. Listing company has agreed to pay 4% to a buyer agent. Do we even know how much the listing firm is going to keep for themselves? No. And we don't need to. All we do know is 4% over here and some question mark percent over here. But 4% of what? 4% of what? In fact, did I even need to do this math just now? No. So don't think 4% to the buyer, then let's take 4% of this. That's going to throw you off. It's not 4% of this. That'd be like pennies. That'd be nothing. Not worth the trouble. Not worth all the headache you got to deal with to make the money, right? It's 4% of this. So don't forget the little helpful hint. If they're talking single-digit percentages, they're probably talking about how much the individual firms are getting as a percentage of the sale price. If they're talking about double-digit percentages like 40, 50, 30, 70, 80, they're talking about the split between the firm and the, in this case, buyer agent. Over here, it's going to be the firm and the listing agent. Human. Again, irrelevant because we don't even know how much the firm's keeping for themselves. So 4% of the 235 is the number we need. We can disregard the total. Oh, we do know it's 7% total. So over here, these guys are keeping 3% for themselves, but it's still irrelevant. They've agreed to pay the buyer's side 4% of the purchase price, which is $9,400. And of that $9,400 that's gonna be over there on the ABC Realty side, What is Jim split with his firm? What does he take home compared to what he brings in? What is his split with his firm? Yeah, half. He gets to keep half of whatever he brings in. 50-50 split. Not an uncommon percentage for a newer agent, by the way. That was my very first split because I joined a large independent firm, and that's just the way they did it. So 50% of this total, $4,700. Does that help? $13. Yeah. Home sales for $86,597. There's a $45,000 loan assumption. What is the value of the excise tax printed on the sales contract? Oh, sorry. Thank you. There you go. Home sales for $86,597. There's a $45,000 loan assumption. What's the value of the excise tax printed on the sales contract? Don't get caught up in, I didn't think you printed that on the sales contract. Not exactly sure why it's worded this way, but what they're asking for here is how much is the excise tax? So what's the excise tax? And by the way, do we even care about this loan assumption? That's just extra information to throw you off. So we're going to take that $86,597 and do what with it? Going to divide it by 500. You got it. That gives us 173.194. So I've got this so far. And then we need to round that up to $174. $174 is how much that excise tax is going to be. How much would excise tax be on a $1 million sale price? You got it. Now, like, that's real money. It's like, oh my gosh, I got to pay that much in tax. Yeah. Yeah. It is what it is, right? Is it something the seller has to pay for? Unless they tell you otherwise, for the purposes of this class, then yes, the seller pays excise tax. But in real life, and unless they were to tell you in the question, it's negotiable. It's not a law or a rule. It's a what do you call it? What's the word I'm looking for? It is can't think of my word. It's just the thing that we tend to do. And it's actually written in the standard offer to purchase and contract 2T as what's going to happen. But it could be changed. But for the most part, unless they say otherwise, seller's paying for it. We'll learn that in the next chapter we're talking about. What else? Unless you tell me other one. Oh, there we go. 9 and 50 were those other ones. Good. 9. Outstanding mortgage of $21,275. About to share it with you. There we go. $21,275. If the seller wants to net $50,000 after paying off the mortgage and a 6% commission, what amount must the sale price be? So this is a good old seller net problem, real world math that we need to know how to do. How much do we need to sell it for in order for that seller to be able to end up with $50,000, pay their loan balance of $21,000, and pay you 6% of the sale price? Number one error students make is they short themselves. They end up getting 6% off of the net after, but not the sale price itself. So what do? We list out the dollars. What are we dealing with? We've got a $21,000 $275 loan balance. Seller's loan must be paid. We've got a $50,000 wish net. The seller wants to net $50,000 so they can do whatever it is that they want to do next. And a 6% commission, and that's the thing that throws people off. So take the dollar portion of things and figure out how many dollars do we need to account for. And so that $71,275 needs to be 94% of what sale price? Why did I say 94%? Because if we think in terms of our relationship with our seller as a split, and the sale price that we're trying to figure out is 100%, that's 100% of what the house is going to sell for is the sale price, right? Brilliant statement number one. Your portion of that is 6% of the sale price, which means the seller's portion of that is the remainder 94. So 100 minus 6 or whatever your commission you're charging is. That's the little magic number you're going to stick right here. Then we can replace the is with a division sign. And there it is. That tells us what we need to do. 75,824 is what it needs to sell for. Now, you're going to get 6% of 75,824 instead of getting 6% of 71, which is what most people tend to try to do. Right? We okay there? I think 50 was requested, if I'm not mistaken. Optionor gave the following option on a property he had for sale. For a $2,000 option fee, the optionee can purchase this address for $180,000 by December 31st, 2017. Which of the following is not true? So again, depending on how tired you are, I'd write it out on your scratch paper. Number 50, ABCD. Is it true that the option contracts are time is of the essence? Are they flexible? Or are they only good for a certain amount of time? Hardcore time is of the essence. Well, we know the answer here. We know that the one that's not true is D. Therefore, all of these other three are true. Option contracts can't just last forever, right? You have the option to purchase it for a specific amount of time. I don't have an example to show you because they don't make us one. You'd have to get an attorney to write one up in real life. But legally, the option contract ends. It's a definitive, defined amount of time. The optionee can maintain the right of subsequent negotiations during the term of the option, which is true. The optionor can keep the option money if the optionee decides not to exercise his option. Well, that's the point of the option money. You're buying the amount of time that you want to have to think about it. It wouldn't do much good if you didn't have to pay for that amount of time. Then you wouldn't have consideration. A legal contract must have consideration, among some other things. So that is also true. Which of the following is not true? The optionor can rescind the terms of the contract at any time prior to exercising the option. No, that's not true. They have to sit back and wait. They can't do anything except just sit and wait for the optionee to make their decision. They certainly can't rescind. Questions? Go to the end, work our way back. Which of the following is correct when comparing a fee simple determinable to a fee simple subject to a condition subsequent? Okay. comparing fee simple determinable and fee simple subject to. Well, what are both of these examples of? Both of these types of estates are the two types of what? That's true. That is a true answer. But more specifically, if we dive down further, fee simple absolute? No, that's its own thing. It means great, no conditions involved. What's the other kind under the inheritable versions of freehold estates? Life estates, fee simple absolute, and then the one Joseph has said, fee simple defeasible. On the chart, it was the one in the middle. And so these are both types of fee simple defeasible. So we know we're working with things that have conditions involved. Seller has sold them to you with conditions in place. And what is the difference? I think of them as the little one and the big one, right? Fee simple determinable, the short phrase, fee simple subject to a condition subsequent, the long phrase. So what do we know without even reading the answer choices? This one is, which one does this mean? Is it that you must keep using it a certain way or you must not use it in a certain way? Fee simple determinable means what? You have to keep on using it as a farm or you must not use it to sell alcohol. You keep on using it in a certain way. There you go. So let's see. Fee simple determinable ends automatically when the condition is breached. Fee simple subject to does not. That was the other piece of these two options. What happens? Do you lose your ownership of it automatically or not? Yes, when it's fee simple determinable. No, when it's fee simple subject to. What if fee simple subject to means you must not use it in a certain way? What if you violate that? Do you lose your ownership of it automatically just because you did serve alcohol on this property? No. The seller who sold it to you would have to pursue you in court to get it back. We don't need to worry about how that actually goes down, what's involved. You don't get caught up in the yes buts and what if this. Just know the basic premise, the basic rule, because in real life, you're not even going to touch this. You're going to get a whiff that this is going on, and you're going to refer them to an attorney as soon as possible and realize that you're probably not going to list this property anytime soon, right? You're going to have to wait until some things get worked out. So for the purposes of this test, just know the basics. I gotcha. Good luck with that, Kirsty. Sorry about that. Fee simple determinable is a non-freehold estate. Well, that's not right because freehold means ownership, and that's what we're talking about. Non-freehold means what? What's a non-freehold estate? Not ownership, but yeah, rental, lease. There you go. So that's not right for this answer choice. Fee simple determinable is not inheritable, but it is. It is. On that chart that we have, stuff on the left was inheritable. The types on the right were non-inheritable. What are the two kinds of non-inheritable freehold estates? There's one. Yeah, there you go. Conventional life estate and marital rights. There you go. Fee simple determinable ends only after court proceedings, while fee simple subject to can be ended through contractual agreement. No, the ending of a fee simple determinable is automatic, as we saw from the actual correct answer. All right, put any more that you think about in the chat, and we'll take ourselves a little 10-minute break and get back into the content unless I have some other questions you want to go through. See you in 10. Welcome back. Anybody have other questions from the midterm? They'll probably come up. There we go. So it's open season. Feel free to mention more later. We'll talk about some more later unless you have some. Whenever you have them, just let me know and we'll go over them. Okay. We are working our way through the finance. And we talked about the primary mortgage market. What's going on in the primary mortgage market? What's happening there? I mean, what's the activity happening? What's taking place? Consumer, I'll give you two choices. The consumer is getting a loan from a bank, or the bank is packaging up loans in big bundles and selling them to another. Which thing is happening? Primary mortgage market. That's that street level, right? The street level, you're making a bunch of individual loans. The bank is loaning out money to individuals, accumulating a whole bunch of them, and then they will package them all together based on same levels of risk and sell them on the secondary mortgage market, which is when we talked about Fannie Mae, Ginnie Mae, and Freddie Mac. We talked about that Fannie Mae deals in all of these, conventional, FHA, and VA, but they're a little nervous about the FHA and VA loans, and if it were not for this other marketplace called Ginnie Mae, Fannie Mae wouldn't even touch them. Fannie Mae wouldn't have anything to do with FHA and VA loans because they have more risk, because there's less down payment, less equity, right? Less skin in the game. People may be more likely to walk away. A couple reasons. Number one, less money that they have put as a down payment, and their credit scores can be lower in order to get those loans. So they've proven to be less likely to pay as compared to conventional mortgage borrowers. We talked about conventional loans. That means what? Who's getting a conventional loan? What do you have to have in your favor in order to get a conventional loan? Good credit. Yeah, for sure. Solid credit, good credit. A little more down payment. You can get them for as little as 5% down, maybe even lower, depending on how good your credit is. But what if you have a conventional loan and you're putting 5 or maybe 10% down? Is there a way the lender would be okay with that? What are they going to require if you put less than 20% down on your conventional loan? They're going to require mortgage insurance in the form of PMI. When you see PMI, think that's for conventional loans because that stands for private mortgage insurance. When you see MIP, you're going to think, oh, that's an FHA loan because that stands for mortgage insurance premium. But they are both types of mortgage insurance. MIP, PMI, it's the same goal, same tool. It's just one is for conventional loans and the other's for FHA loans. And so for conventional loans, this PMI is charged by the lender. Buyer has to pay for it because they're putting less than 20% down payment. Just to give that lender a little bit more of an incentive to make them the loan, even though they're putting less than the 20% they would rather they put. By the way, what happens? So this lender says, well, you're putting less than 20% down. Another way to word that would be you're going to have less than 20% equity in the house when you first buy it. Does that make sense why I say it that way? Because the only equity you have in the house when you buy it is what you put as a down payment, right? For the most part, for our purposes here. So that lender says, well, therefore, I want to charge you private mortgage insurance. What's going to happen over time, though? We've talked about this before. You buy this house. Let's say you put 5% down. So that's how much your equity is. Here's the full sales price. So if you wanted to hurry up and get more equity, what are some ways you could increase your equity? Maybe your plan is to sell this house in 2 to 3 years. And so you want to hurry up and have more of your equity, walk away money you're going to end up walking away with when you sell it. Yeah, renovations, capital improvements might be another way to say that. Is a way to increase your equity. You can make it worth more. That's certainly one of them. What's another one? What's another way you could increase that your equity? Let me ask it this way. What's another way your equity could go up? It's really nothing you did except buy in a smart area, because appreciation is a huge benefit of real estate. Over time, if you go through a long enough time period, pretty much all real estate appreciates. I mean, there's certainly exceptions, but it's going to be an amount of appreciation over time. It's just how much time are you working with? So appreciation adds to your equity, and then also paying the loan down. Making your payments. Paying down the loan amount or the loan balance over time adds to your equity. So you bought it in this year, first year, and then you've done each of these 3 things, and maybe your equity has gone up to 50% after a few years. So now when you sell it, you're going to have to pay those greedy real estate agents. But before you do that, when you sell it, you're going to walk away with half of what you sold it for if your equity was 50% of the value. So if all that is true, and you started out owning this thing first day, you closed on it, here's that magical 20% that the lender wishes you would have put down, but you only put down 5%. That's not a great place for that line to be. It's probably more like down here. Lender would rather you have put this much, but you only put that 5% level in. What if, as time goes by, your equity gets up to this 20% level? Well, that's what they wanted from you to begin with. That's why they started charging you PMI. In other words, can you get out of paying the PMI eventually? If what makes the lender nervous is that you have less than 20% equity, once you hit 20% equity, that PMI drops off. Now, in real life, it drops off at 22%, but when it hits the 20%, if you suspect you've reached the 20% of equity because of those 3 things we just talked about, you could ask your lender, hey, I think I'm there. I don't want to pay you PMI anymore. And they're going to say, okay, well, if you say so, you don't have to pay it. Wrong. They don't say that. But they say, well, let's see about that. You can submit an application. It's probably like let's just see. They might probably ask you to pay an appraisal, pay for an appraisal to prove what it's worth. It has appreciated to a certain point. Oh, you put some money in it. You added a room. You closed off a carport, made it a garage. Send in proof that you did these things, what you're dealing with. They're going to get a reevaluation. get an appraisal. And if it comes back and they discover, yeah, okay, based on what they're worth now and what you've done to it and how much you've paid your loan down over these 5 years or 10 years, then yeah, you've got there. You're there. We're not going to charge you this PMI anymore. Congratulations, you're saving $80 a month. It's quite possibly 80 to 100 and some dollars a month. So that's a big benefit of a conventional loan. Putting less than 20% down, you got to pay the PMI, but eventually you could grow your way into not having to pay PMI anymore. Were you okay with that idea? Because it's very important to understand the next idea. When we're talking about an FHA loan with MIP, you never get out of the PMI. It stays. Even if you've grown to that 20% appreciation, because it was an FHA, that MIP, mortgage insurance premium, never goes away. So let's think about a buyer who's got the two options. One option is a conventional mortgage. The other option is an FHA mortgage. Why are they drawn to the FHA one? We've got the conventional, we've got the FHA. They're tempted to go with the FHA choice because it's a lower down payment, 3.5%. The conventional typically is no lower than 5% as a down payment. The FHA allows for a lower credit score. Conventional requires a bit higher. What if you're okay on the credit score, so that's a non-issue? Now you're really just thinking, well, do I want to put 3.5% as a down or 5%? Buyers frequently have this consideration to think about. But here's the big tiebreaker. Is the money I have to part with up front worth it to me to have the possibility later to get rid of that extra PMI? And if the PMI is, let's say, $80 a month, but what's the difference in these two amounts? 1.5%. We're talking about a $200,000 loan amount. The $3,000 difference that I've got to put down for this conventional mortgage, how long will it take me at $80 savings per month to have spent that? That's really what you should probably be doing and encouraging your buyer to think about as to which one should they pick. Is it more important to you, buyer, to put $3,000 more down or save $3,000 by just only putting 3.5% down in order to someday get rid of this $80 a month, or it could be whatever, $100 a month. In this case, you're going to need 37, I think is what I just saw. 3,000 divided by $80 a month. That's 37 and a half months, which is only 3 years. So that's a great question to always ask your client. How long are you going to be there? A year? Well, then no. Let's just go with the cheapest way in, because you won't even be there long enough to pay your way up to 20% equity. Oh, this is like a 5-10 year house? Well, then you probably want to just go ahead and gut it out and come up with $3,000 more if you can, and get a conventional loan instead of an FHA loan. Other benefits, by the way, are it's probably cheaper. Fewer fees on a conventional loan, less fees than FHA. The FHA is for people that need help with down payment and because lower credit scores, but it's pretty universal that you should encourage your client, look, talk to the lender, and if at all possible, it might be in your best interest to try for the conventional loan. But it really depends on their goals. But that's the testable question. Can you get rid of MIP? No. FHA loans, mortgage insurance premium never goes away. Now, I just said that, but let me roll it back. What's a way that you could stop paying MIP on your FHA loan? You're just tired of paying it. It's been 10 years. You're way past the 20% equity. There it is. Corey says, make it not FHA loan anymore. Refinance it into a conventional loan. That could be another solution. Start out however you need to get the house, FHA, fine, but then have a plan to figure out how you can maybe refinance into a conventional loan later, right? Or sell it and go buy something else with a conventional loan. So all of those sorts of things are not really so much what you're going to talk to them about, more like, hey guys, just think about this and now go talk to the lender about it. You don't get too much in the weeds with the finance side of things. Your job is the real estate side. So unless you're really good with it, even then, unless you have a accounting degree unless you're a CPA or a bookkeeper, tax preparer, probably best just to take your real estate license and do real estate with that client and tell them what could be and have them seek outside counsel for those things. But it's good to know so that you can point out the possibilities. So that's the big potential question for FHA loans. Lenders, oh, by the way, lenders make the loans. Lenders, Bank of America, Wells Fargo. In other words, the government doesn't. Just because it's an FHA loan doesn't mean you're getting the loan from Uncle Sam, the government. You're getting it through your normal lenders you would go to. It's just that lender is going to say, oh, we need to do an FHA loan instead of a conventional because this borrower has more challenged credit, lower down payment, whatever. FHA does not originate loans. That means make them. The lenders make the loans. The lenders set the rate. Just because it's an FHA loan doesn't mean that the FHA, Federal Housing Administration, dictates the rate. The rate is the same, created by the same thing as it always is, no matter the type of loan. And the lender actually does the loan approval. FHA does not. It just happens to be an FHA loan. What is FHA's role here? The big one, the big testable one, is it is insured, by the FHA. The government says we will insure this loan, lender, so you don't have to worry about it. We have that MIP in place to kind of lessen your risk, lower your risk. So the word insured is really important when we're talking about FHA loans compared to VA loans. VA means Veterans Affairs, Department of Veterans Affairs. Those are guaranteed by the government, not just insured. You don't have to get too much into the details of what those differences are. Just know that that's very testable. And if you see it on the test, which type of loan is guaranteed, then the answer is VA. Don't fall for FHA. Don't answer conventional. Conventional doesn't have any sort of government backing to it. Government's not going to guarantee or insure a conventional loan, but they'll guarantee they'll guarantee a VA loan, and FHA will insure an FHA loan. Not guarantee it. Guarantees the word for VA. What are some benefits for FHA? We've talked about it. Lower down payments possible, lower credit score, higher debt to income ratio. That's another one. What's the debt to income ratio we've talked about so far when we've been dealing with the one for conventional. Do you remember the DTI or debt to income ratio? How much of what you make in a month gross can go toward your house payment? Yeah, for conventional, it's 28 for the house payment on the front end ratio and 43 on the back end ratio. 36 on the back end ratio. 28, 36. FHA is 43 on the back end ratio. In other words, you could spend more of your money on your car payment, your credit card, and your house payment when you're getting an FHA loan. Well, if you have kids, you have a household, you have a family, you've got a lot of commitments, medical bills, all the more reason to help somebody who otherwise couldn't afford the house payment. And people, I forgot the stat, I just saw it the other day. A lot of people are broke, right? A lot of people have very little in savings. Like the average savings balance was just one disaster away from wiping people out. So if you're helping somebody buy a house that they normally couldn't, helping an FHA, that's the purpose of FHA. And a lot of times they have a lot of bills that they're paying, a lot of recurring debt. And so let's raise the amount that they can put toward that to qualify for the FHA loan. If they were limited by that 36 number back end ratio as in a conventional loan, you'd have fewer people being helped, right? And not allowed to have a prepayment penalty. That lender cannot say, I'm going to penalize you for refinancing into a conventional loan or selling and paying me too early. Prepayment penalties are not allowed for FHA or VA loans. But the big negative, again, is that MIP for FHA loans, MIP never goes away. With VA loans, they're guaranteed by the government, by the Department of Veterans Affairs. Again, VA is not the one who makes the loan. The lender makes the loan. Just like with FHA, the lender makes the loan, sets the rate, approves the borrower. VA's role is to guarantee the loan. Now, every rule has an exception. And for VA, if that veteran or spouse of veteran wants maybe to buy a house in an extremely rural area, sometimes a lender might not be willing to loan the money because it's such a rural area. In that case, if there's no lender options, the VA will step up and say, we want to help our veterans, we'll help our military. We will make a direct loan in this case because there's no other option. So that is the one exception where VA would actually originate a loan if there's no other choice. Positives for VA, the lowest down payment possible. Nothing. Bring in nothing. You are allowed to prepay without the penalty. They are also assumable, meaning anybody, veteran or otherwise, doesn't have to be military or veteran person, they could assume the VA loan that you've got. If you're military and you used your VA eligibility to buy a house, and now you want to sell your house, but that buyer wants to assume your loan, that is something that can happen. However, the VA would have to approve of that buyer. That would have to be what's called a qualifying assumable loan. Back in the 80s was the last time that there were non-qualifying assumable loans where people did not have to qualify and have a certain level of credit and credit history. But now they've got to qualify. But it could be that somebody who's non-military or who is military, a VA loan can be assumed, but only if that buyer qualifies for it. Now, a couple things about VA. There's some funding fees paid at closing. That's a negative. Extra money. Costs more to get a VA loan than a conventional loan. That's one of the reasons. That funding fees, origination fee, that's pretty much on every loan, but how much is it? That's just going to depend on the lender. And that veteran can only get one VA loan at a time for the amount of eligibility. They'll be given a certificate of eligibility, a maximum amount that they can borrow, depending on how long their entitlement depends on how long they served and what type of discharge when they left. So they're entitled to a certain amount. They get a certificate of eligibility, and they've got to prove that it's worth it. Oh, that sounds like something we've talked about before that we're going to talk about in its own chapter called an appraisal. So a certificate of reasonable value is the appraisal used in a VA loan. When it's a VA loan, they don't call it an appraisal. They call it a certificate of reasonable value, but it's the same concept. They need to prove that that property is worth it. So the VA is willing to be involved in this, and the lender is willing to loan the money. Because it's such a special kind of loan designed to help people who normally couldn't afford a house or have the privilege, give that military person the privilege of having home ownership for their service, then the appraiser who's issuing this certificate of reasonable value needs to know how VA works. They need to go through certain classes. And I met one today and went out to a listing that sold, talked to the appraiser, and he said, yeah, I just finished my VA certification classes, so now I can do VA appraisals. He's got to know what the VA cares about. Because when an appraiser appraises a VA loan or a home purchased using VA financing, they're looking for more stuff. They're tuning in to condition of the house more closely than when it was conventional. If it's a conventional loan, the lender doesn't care as much about the condition as they do when it's a VA or an FHA loan. Again, it goes back to what's the purpose of VA and FHA loans? To help people who otherwise couldn't have home ownership. Well, let's not set them up for failure by letting them buy a house that has a roof that is at the end of its life. Most shingles, by the way, anybody have an idea how long the average shingle is expected to make it? When you put a new roof on a house, those shingles are good for how many years? You'll see it on the packaging. A lot of times it'll say this is a 30-year shingle, 25, 20-year shingle. Depends on how much they cost and how well they're constructed. In real life, how long are they going to last depends on a lot of factors, like are there a lot of trees, there's a lot of damage, a lot of wind damage. But for the most part, you might get 20, 25 years out of a roof. Well, if that roof is close to that 20, 25 year mark, the FHA or VA appraiser is probably going to say, I'm not going to authorize this loan unless a new roof is put on the house. The subtext to that is because I don't want this owner to have to do it next year, right? We want to make sure they come into a house with a reasonable amount of time without having to make a big expenditure of money. So it's the roof needs to be in good shape. What are other FHA, VA requirements? Must have a working range. The oven needs to work because that kind of goes back to livability, habitability. Can't have broken windows, or the FHA lender or VA or appraiser, is going to say those windows need to be fixed before we will authorize this loan. And that means the seller, if they want to still sell to this borrower, is going to have to fix some windows. If they don't, the borrower might say, well, I'll do it. I've got some money. I can borrow some money or get some from grandma. Somehow those windows need to get fixed because you're not getting that FHA or VA loan unless it has unbroken windows. Big holes in the wall, that's another red flag. And then also peeling paint down to the wood. For houses built before 78, lead-based paint issues, right? So FHA, VA loan appraisers are looking for all these sorts of things. And by the way, if you're a listing agent going on an appointment, talking to somebody and the house has a lot of those sorts of things wrong with it, are you going to say something to your seller client about offers you might receive? Like this, hey, seller, we might want to just tell everybody in the MLS, don't even bring an offer if you need FHA financing because we're not going to fix anything. And we don't want you to have to give us due diligence money that you'll never get back if it turns out that the roof is too old for that FHA appraiser to be happy and turn down your loan, right? You with me? So it just has been a product of the economics these last couple of years, sadly, that a lot of FHA and VA borrowers lost out because sellers had the privilege of not having to fix things. They had the privilege of choice. They had a lot of offers coming in, and they tended to pick the ones that didn't require them to fix stuff. Why pick an FHA offer if you have 3 conventional ones where you're not going to have to put on a new roof? Now, it's not that they were required to put on a new roof with that FHA appraiser saying something about it. It's just that they would have to let that buyer walk away and then wait and find a new buyer who didn't have it depend on the roof qualifying, right? Didn't force the seller to buy roofs. It just forced the seller to take up the extra time. So why waste the time if you know it's going to be an issue? And it was sad for buyers. It still is, who maybe didn't notice that sort of thing. And I mean, that would be kind of shame on the agent. An agent should know enough to help their buyer understand. Let's just not even look at it if it's a certain level of fixer-upper. If it's got all those things wrong with it, then we don't need to be looking at it if your only option is an FHA loan, because we know it's not going to pass an FHA appraisal. And we're not even talking about the inspection yet. So an appraisal for an FHA loan or a VA loan is sort of like a little bit of an inspection too. Conventional, not as much. But all of those things come into play when we're talking about different loan types in real life. What's testable? These things. It's a certificate of reasonable value. That's another word for appraisal when we're talking about a VA loan. It's got to be a VA approved appraiser. That veteran military person needs to get their entitlement amount, again, determined by how long they served and what kind of discharge they left the military with. And we're looking for a certificate of eligibility to see what the maximum guarantee is that the VA will work with. Now, if you are a veteran and you've let somebody assume your VA loan, here's the thing. Your eligibility is down. It's all tied up in the one you let someone assume. You can't go get another one until that one, or unless you have enough eligibility left to buy the next one using FHA financing. So that's a big negative for even going along with letting somebody assume your VA loan. Probably why most people don't, because they want to use the VA eligibility for their next one. USDA, it's a government-related loan, not about the military. It's about the location of the property being in a rural area, and it's about the borrower not making more than a certain amount of money. So to qualify for a USDA loan, the household must not make more than X amount. It's probably like $70,000, $80,000 a year, full household combined, but you could look that up. That won't be a testable thing. But it's low to moderate income limits is what they're looking for. The down payment it's another little zero down payment possibility. USDA subsidizes the interest rate, kind of helps that low to moderate income family or person make the payment because they help with the interest rate. But the problem with it is the money can run out. It's in the budget set aside every year. And so if a bunch of people have applied for USDA financing, by the time your client does, sorry, there may not be money left over. Got to wait till next year if this is their only option. They would make potentially direct loans. They are guaranteed by the USDA, like VA are guaranteed by the VA. Other kinds of mortgages, purchase money mortgage. Whenever you see that, think seller financing. Purchase money mortgage is a type of seller financing. An installment land contract is another type of financing, seller financing. But this is a purchase money mortgage. That's all we're talking about. Some version of the seller being the bank. A bridge loan. Anybody know what a bridge loan does? What does that help you accomplish? Bridge loan. Think about this situation. You are trying to buy a house, but you haven't sold yours yet. But the perfect house just came up for sale. You don't want to lose it. Is there a way you could qualify for both mortgages? Well, that's what a bridge loan would accomplish. It's probably a 90-day term, short term, higher interest rate. You're going to pay for the privilege, pay a little higher interest rate, but it lets you grab that one and then worry later about getting yours sold. But you better hurry up and do it. So it's not like just take forever to accomplish this thing, but a bridge loan lets you bridge the gap between getting yours sold and buying the one you want to buy so that you don't have to sell it first. An open-end loan lets you add more to your loan balance later. They approve it in a way that they can say, well, if you need more later, let us know, and we will give you some more later. Open-ended mortgage. A buy-down, that relates to discount points. So what if you couldn't afford, the rates kind of went over 7% here recently. They're like 7.5, 7 7/8 maybe. Depends on the rate, but what if that's just too much? If you were able to get your hands on some money, or if the seller wanted to motivate and incentivize you, as they do when it's more of a normalized market or a buyer's market, that seller could beat other sellers by giving you, the buyer, an incentive to pick them because they could say, well, I'll give you enough money to pay for a 3-2-1 buy down. That might be one type of buy down. And what's that going to do? They're going to pay enough discount points so that, as I look for there it is, 3-2-1 in the first year of this 3-2-1 buy down, maybe they will do your interest rate. They'll set it at, and I'm just pulling numbers from air, 6.75%. So your monthly payment will be based on that in the first year. The second year, it's going to go up to 7, and the third year, it's going to go up to 7.25 and beyond. 3-2-1 buy down. They're buying your rate down enough to get to that point, and then a little higher, and then a little higher. There's a 2-1. There's different kinds, but a buy down is basically paying discount points so that borrower could have a lower rate in the beginning, but it's going to rise over time. A reverse mortgage. Anybody have an idea about what that means? A reverse mortgage. If you ever watch TV, when the older people watch TV, like Mid-Morning, Price is Right, you notice the commercials are geared toward older populations at certain times. You might see commercials for reverse mortgages because they tend to, Corey says that pays you. How is that possible? It's because they're looking for people who already owe or own the entire property free and clear. They don't have a mortgage anymore. And so what they do have is 100% equity in their house. And what they're worried about might be end of life, right? And they're worried about making their monthly obligations because they don't work anymore in that case. Doesn't have to be, but it tends to be. And so what's a way for them to get income? Well, they could deduct a little bit of their home equity and just receive a payment every month. So it's a lender who's saying, I'll give you a loan where I will send you a payment. The lender pays them, but every time they pay them, their equity decreases. And so eventually that's going to run out. So it's sadly this weird kind of a time factor of how long do I need to pay for bills? In other words, will I still be alive? Versus how much equity is this house? How much is it worth? And is it going to run out of equity before I run out of lifespan? So that's part of the decision in whether or not to get a reverse mortgage. A package loan would be something where, like, let's say you buy a model home. You ever been in a new construction model home? They've spent $90,000 decorating and picking furniture just for that house to make it look great. Well, say you're buying that and it includes all that furniture. A package loan lets you finance both the real property and the personal property. A blanket loan is something developers like to use because it's a loan for the whole project of 4,000 houses. But as they sell one by one by one, the loan doesn't have to get paid off. It's just decreased by that property's worth. So it's a way for that developer to let their loan decrease as they sell a house. 1, 2, 3, all the way down to finally the last house they're selling. That's a blanket loan. Construction loan, when you're building new construction, you can borrow from the bank. And you don't want to just borrow the full amount. They won't let you borrow the entire $500,000. Why not? Because you have no collateral to offer them yet. It's not even built yet. They're just going to loan you chunks of money as you need it along the way. So a construction loan is given to you in what are called draws. So you'll say, look, I need to pay the people who are going to pour the footings. Okay, here's $10,000. Your general contractor will get that draw, get the work done, have a inspector come out and make sure the work was done. The money was really spent for that. The work was done, and now they can get the draw and pay for it. Once that's approved, the next step is probably putting in the flooring and the framing and the siding and the roofing. And those various stages of construction, they're going to pull the amount of money needed for that work along the way. And then finally, a home equity line of credit or a home equity mortgage. It's basically a version of a second mortgage. Your first mortgage helped you buy the house. Now you've got some equity in it. You might have it right off the bat because maybe you borrowed you only borrowed 50% LTV because you put such a big down payment. But you have equity in the property and you want to borrow against it. For what? Why would you use equity in your house? What sorts of things would you want to pay for using the equity in your house? All kinds of stuff. Could be other property, could be cars, could be improvements. That'd probably be the smartest way, is to do something that's going to make the property have more value. But sadly, I think people use it for disposable things too. But all it is the lender saying, well, how much equity is there? Guess what? We need to have an appraisal done. And they might determine that there's 60% equity in the property. They're going to not let you borrow that entire 60% of it. They might let you borrow 80% of the 60. You with me? They're not going to let you borrow the entire equity. They want a little bit of a cushion. And then that's just basically a debit card. You could swipe it, and with every swipe, your equity goes down a little bit, or however much that amount of purchase was that you used it for. It's also pretty nice to have just as a reserve, a safety net. You've got that open home equity line of credit available to you in case disaster, emergency, or school tuition comes due, whatever it might be. So home equity line of credit is a question to ask when you're on a listing appointment. Hey guys, do you have a mortgage? You do? Okay, do you have a second mortgage? Home equity line of credit? Some people don't understand that that is a second mortgage. It's just an extra mortgage on top of what they used to buy the house with. And so you might find out, oh, your payoff is $800,000, and that's what you prepared the net sheet with to tell them what they're going to walk away with. But then you find out later, oh, yeah, by the way, we have a home equity line of credit for $30,000 and we've used it all. Well, they're not getting the same number anymore, are they? You need to subtract $30,000 more from the net that they're going to walk away with. So ask that question soon. And it's worded in our standard North Carolina listing agreement. It has it spelled out. Is this a primary mortgage, a secondary mortgage, home equity type of situation? Mortgage priority, subordination, just a vocabulary term. It just means a lower priority lien gets put ahead of a higher priority lien. And normally they're put in line of priority based on when they were recorded. But what if the smaller amount loan is in place first? We need to bump that down. The first mortgage, maybe you get a refinance for a larger chunk. You already have that home equity line of credit. That bigger mortgage, they're not going to be happy with the second guy's being first, the smaller one being first. They're going to want to be first in line. So you would subordinate that second home equity line of credit, smaller loan balance, beneath the big guy. Because in order for that big refinance first mortgage to agree, they're going to require subordination of other loans behind them in order of lien priority. So that's what subordination is. We talked about the process a little bit. The first point of contact for that borrower is the one explaining the way the loan types are, the rate itself, and that person is the loan originator. They're originating the loan, they're creating it. They are talking to that borrower face to face, getting the information about their income and their credit score. They're collecting the check for the credit report, collecting a check for an appraisal, and they're asking the questions about income and tax. I just lost my word. W-2, check stubs, bank balances, tax returns. That's the word. And they're getting all that gathered up in the beginning to make sure should we even be bothering taking our time to do this? How likely is it that they can qualify? They're going to gather a couple of things. Then the person's going to apply for the loan, fill out an application. And for purposes of RESPA guidelines, Real Estate Settlement Procedures Act, That day of loan application is the moment when the address of the property is given. There's a RESPA requirement that says the lender must give that borrower that loan estimate. I think I showed it to you last week, showing exactly what the rate is. Is there a prepayment penalty? How much is your payment going to be? That loan estimate document is due to the borrower from the lender within 3 days. This is very testable, by the way. Within 3 days of the loan application date. What's the loan application date? When they've applied for the loan and given the property address. Now the lender's got a time frame. They got to provide the loan estimate from that 3 days from that point. So what are they looking for? Credit score, credit history, explanations of things that they don't like the looks of, and analyzing that borrower. That's part of it. The income itself, what is your monthly income, and what proportion of your monthly income can go toward the house payment versus the house payment plus recurring debts. So that's adequacy of income. And then let's make sure the property is worthy. We need to have an appraisal, and we need to do a title search, title investigation. For the purposes of originating a loan, how do we determine what a property is worth? With an appraisal. In other words, as we'll learn in chapter 17, the lender could not save extra money by choosing to get a broker's price opinion instead of an appraisal. They can't get the determination of value from us. They're going to have to pay an actual appraiser to get an appraisal. And it's going to be, it's cost more. An appraisal is probably $500 or $600. When we do a price estimate, we call it a probable sales price using a broker price opinion or a market analysis. We probably could only charge $7,500 for that. So the lender would have to get an actual appraisal when it's for making a loan, originating a loan. So that originator gathers up those initial documents, hands them off to the loan processor. And the processor does a lot of work with checklists. You never even meet them usually. They're asking for more stuff via email. They might say, we need this is dragged out another week or two. We need another bank statement, another check stub. We need, in order to maximize your chances of getting approved for this loan, we need an explanation of why you had no job for 6 months. And, you got a different job in the last 3 weeks. Well, is it the same type of work? They're going to like that answer more than if it's a whole different field, because it's going to be like you just got a brand new job and you know what you're doing. Are you going to have that income continuing to come in? So they're going to ask for extra stuff. It's good to prepare our buyer clients. Look, guys, you're going to feel like a criminal. They're going to ask you questions over and over again, and that's okay. Just know that's the system. They're not picking on you. It's just that there was so much loan fraud, there still is some, that they want to make sure that everybody is on the up and up and that they have the best likelihood of you making your house payment. And so they want proof. That's why they're going to ask for a lot of things along the way, sometimes more than once. So that whole process, that loan processor is getting all of these extra documents along the way. And then finally, they want to put all that in a nice little package with a bow on top and pass it off to the loan underwriter, whose job it is to say, yes, we're giving you the money, or no, we are not. So a good processor wants to make sure they've done everything they can to make that loan package as complete and concise as they can, so that underwriter has all the info they need to make a decision. And that's the basic people involved in this process. So another thing that comes up is the interest rate and the fact that it can change daily. So a rate lock is an issue we'll talk about when we come back from break. See you back here in 10. Come on back together. There we go. All right. So rates are pretty volatile, right? They could change daily. And because of that, if you know your closing is in 30, 40, 60 days, and the rates are maybe lower than they have been, but they kind of peaked, they started to level out, you might not want to trust that they're going to stay low. For whatever reason, if you're suspicious about those rates, then you can lock them in. You can lock your rate. It's going to hold that rate at the place at which you locked it for an amount of time, maybe 30 days. That's another issue that could come up if a closing gets extended, delayed. One question is, we're not closing by tomorrow? Well, tomorrow is the end of my rate lock. And if it's the seller's fault as to why it's being delayed, that buyer might want to ask the seller to pay to extend the rate lock another several days. So that's just a real world situation that can happen. And it's an extra fee, right? It's an upfront fee to lock in that rate. And it's just a gamble. Is the rate going to be lower when I actually close or not? And we stay out of that decision, right? That's really going to be between them and the lender. Them and the originator probably is their point person concerning that loan. So we as brokers, we're probably going to not be involved in that discussion. Now we get into the requirements when using financing to buy a house. Guess what? There are laws. A lot of them came as a result of 2008 and all that stuff that led up to it. Anybody watch The Big Short? I ended up watching it. I ended up going back to the gym this past week, and on the treadmill, I watched it about 3 different occasions. It's free on YouTube. I put it there in the Notion just because I happened to stumble across it. They even blanked out the bad words. You don't have to listen to the bad words. They bleeped them out. But it's a nice little microscopic view, little focused view of, it's partially true, partially fictionalized, but it kind of gives you some insight as to how all that stuff works behind the scenes. And what's in place to protect the consumer? Well, when it comes to loans, RESPA is one of the big legislations, one of the big laws in place to protect them. It stands for Real Estate Settlement Procedures Act. That's RESPA. To keep people from being abused by loans. We talked a little bit about how all that happened, right? Some of the things that were going on that they even explain further and mention in The Big Short are higher loan to value ratios, like 125% LTVs, stated income, no documentation loans, people just having ultimate faith in the mortgage sector. What could possibly keep somebody from paying their loan? Well, nobody ever will, so we can just give money out, no problem. And so another issue was if a borrower got a quote from one bank or lender and then a quote from another one, right now, one of them might quote them 7.5% interest rate, but another one might quote them 6.5%. There was a time before RESPA did something about it that they would have to flip through a bunch of pages and look in the fine print as to How is that 6.5% possible? Well, guess what? It's because you're having to pay more upfront in the form of discount points. You're buying your rate down. You're not getting it cheaper from this other lender. They're making you pay for it, and they were advertising that lower rate so as to beat out everybody else. Now it's got to be much more obvious. It's right there on the front page of the loan estimate, by the way. So those sorts of abusive practices, no more mystery fees, no more fluff fees that have no explanation you don't find out about till later. That's been a thing back in the day. Lenders would charge more fees than some. Some lenders would charge more than others. Regulation Z requires disclosure of all fees associated with the loan. Under Regulation Z, you've got to provide, that lender has to provide that loan estimate within 3 days of the loan application. It also regulates real estate mortgage advertisements. What's that mean to us? Wouldn't it be a great way? You ever seen a car ad and yeah, the car is $80,000, but they break it down to what your monthly payment could be. And it just goes down a little easier when you say it could be a $500 car payment, or it could be a purchase, but they don't even want to tell you the price. They want to talk to you about payment. Well, you can do the same thing with real estate. You could advertise, yes, you could buy this listing and it could be a payment of $2,800 a month or $1,800 a month. Well, because of RESPA Regulation Z, if you choose to advertise the payment possible, you can't stop there. Whether you're a lender doing it or a broker, we've got to tell the whole story. And when you pick one of those types of things and just advertise the payment, that's called a trigger term. A trigger term. So it's improper to say that trigger terms are not allowed. That's not true. Trigger terms are allowed. You can advertise with a trigger term. In other words, you can advertise the monthly payment, the annual percentage rate, the finance charges, the amount of payments, the total amount financed. But if you advertise any of that information, you've got to advertise all of it. It's not pick and choose. It's all or none. That's what trigger terms are. So, test question. Can you advertise using a trigger term? If you have a listing and you don't really want to talk about the fact that it's a $900,000 listing, let's talk about that the payment would be $4,500 a month. Can you do that? Yes, but only if you tell them all of this other info too. You better make sure the rest of this gets included in that ad so they are not deceived. Got to tell the rate, the amount financed, the number of payments, the whole picture. And a lot of people did this improperly before this was a requirement. All the credit terms must be disclosed. It's either all of them or none of them. Specific loan-related numbers. And that applies to the loan terms, right? But not everything is a loan term. These things, for instance, don't qualify as trigger terms. These do not require that you tell all of the other parts of the story. You could advertise saying the seller will pay all your closing costs. And that does not trigger a requirement to talk about 30-year loan, $500 a month, blah, 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 this and that and the other. So what's not a trigger term? The seller paying closing costs, whatever the HOA dues might be, credit report fee being paid by seller. These don't trigger the requirement to disclose all that other stuff. And general financing terms are okay. You could say low down payment possible, no down payment possible, low payments or no payments. Again, not trigger terms. The thing that are trigger terms are these: the payment, the interest rate, the number of payments, finance charges, the total amount financed. They are allowed as long as you include all of that information. You can tell them that sexy payment that's extra low, but you better tell them it's only possible with 3 discount points. That's the thing that people abuse the most. They would advertise a suspiciously lower rate, And as you looked in the fine print, you realized, oh, that's if I pay $20,000 up front in discount points, also known as prepaid interest, also known as lender yield. So by the way, test taking tip, discount points, jot this one down because you might see it referred on the test this way. Discount points might also be referred to as prepaid interest because you are paying a chunk up front so as to get your rate lowered over the life of the loan. And then here's the big one, lender yield. Yield is something you're getting, right? You're making. So the lender is getting their profit or a yield because you're paying them upfront interest, prepaid interest, discount points. The lender, meaning the investor, is getting extra money, the money up front, instead of having to wait over time with all those individual payments. So these are all synonyms for that phrase discount point. The Fair Credit Reporting Act is in place to, again, establish consumer rights. That's what requires that, allows consumers to see their credit report once free a year. You can apply and get your credit report free. And correct errors falls under that as well. Most negative information on your credit history is going to last 7 years. Bankruptcies and foreclosures last longer, more like 10 years. All that falls under the Fair Credit Reporting Act. There are 3 major credit reporting bureaus currently. And so different lenders want to see different ones. They might care about some more than others. We're going to talk in Chapter 19 about some equal housing opportunity categories or fair housing categories. And when it comes to fair housing categories, meaning we can't discriminate against people based on their sex, race, religion, disability status, national origin, color, or did I say religion? There's 7 of them, 7 protected classes. Well, when it comes to a lender loaning money to people, they have extra ones. The lender cannot decline a mortgage to someone because of their age or their marital status, or if they receive some of their income or all of their income through public assistance. But age, I have a friend in the business and her grandmother lived to 105. Grandma lived to 105. She moved her down here from New York when she was, I think, like 95. And so she bought a house. She happened to have the privilege of buying it all cash, but if she had had to get a loan and she applied for a 30-year mortgage, that lender couldn't say, you're 95 and you want a 30-year mortgage. You won't pay this thing off till you're 125. No, I just don't think, not allowed. Illegal. Doesn't matter your age, you still should be able to get the loan, right? So age, marital status, oh, you're not married, no loan for you. Not allowed, illegal. Public assistance income is just factored in as more income. You can't get, they're not allowed to ding you or credit you less because some of that income comes from public assistance. So to recap, some terms we learned: Federal Reserve is the major banking system in place. There's 12 Federal Reserve banks across the country, and they loan money to your bank, and then your bank puts a premium on it and loans money to you, essentially. The primary mortgage market versus the secondary mortgage market. The participants in the secondary mortgage market, meaning Fannie Mae, Ginnie Mae, and Freddie Mac. Different loan types: conventional, FHA, VA, and those other little laundry list of specialty types. The purpose of the Federal Reserve is to control the money supply in the economy. Make loans to consumers happens on the primary market. Loans being bought and sold in big chunks happens on the secondary market. And don't forget, when it's an FHA loan, the FHA insures the loan. The VA guarantees the loan. to make it more palatable for that lender to loan the money. RESPA, Regulation Z, trigger terms, protected classes of the lender, all of this stuff. I think I've included giving you these slides in the Google Drive, so you can go back and check those out in your studies. Let's go to the next thing in line, closing the transaction. When you take your post licensing, Post 302 is all about this. It's all about contracts and closings. So it's basically a deep dive into pre-licensing chapters 9, 10, and 21. And it's my favorite one, even though it's a lot of math, because it's the real world. We don't make any money if we don't know how to do contracts and handle closing procedures. So we're going to learn more about RESPA, talk about some pre-closing procedures, the settlement statement itself, our responsibilities as brokers, and quite a bit of math, quite a bit of calculations for things like interim interest, discount points, origination fee again, how to determine what the buyer needs to bring to closing, and how to determine what the seller should walk away with, more than just the net, but the seller's expenses, including excise tax and deed preparation. So we're going to learn all that stuff. Anybody watch HGTV, those real estate shows? I can't, because it's fiction. And while, yeah, I do enjoy fiction, it's like, why are you celebrating? Because you signed a contract. Yes, that is one step toward closing, but you have a long way to go. I've just seen too many fall apart. So don't celebrate yet, right? Now's when the work begins. Your work went from the phase of finding that buyer, getting to the contract. Now you are trying to get them across the finish line. Whichever side you're representing, it's all about, to me, while you owe, of course, most of your fiduciary to your client, all of the old car, there are a couple of choices in how you do this and how you interact with that other agent. Some people take more of a combative role. I look at it like we're just kind of all working toward the same goal, which is let's get this thing to closing. Yes, represent your client, help them negotiate when the repairs part happens in the process, sure. But if something needs to be done, a document needs to be delivered or provided or found, let's all work toward getting this thing to closing, because that's when we get paid. Right? That's when our, first of all, clients' goals are met. Secondly, we get paid. So that's why it's so important. What are some things happening? We are transferring that title, right? The title or the deed is being given from the seller to the buyer. And that's kind of the main purpose of this closing. The other one is that the money is going to be given back the other way in exchange for the deed. Consideration from buyer to seller. Don't forget, what is consideration? What is it? When I say consideration, what am I talking about? Be careful about the terms. What if I said earnest money and due diligence money? What is a synonym, another way to refer to earnest money and due diligence money? Another word for those things together, they serve as liquidated damages in the event of the buyer or the buyer choosing not to buy. But the consideration is pretty much the purchase price. Not earnest money, not due diligence, not even just the down payment, but all of it. It's what the seller's getting in exchange for signing the deed over. Something of value. If they wanted to trade real estate, it'd be the real estate. It'd be cars. It could be most likely money. And it's also, this closing is when the funds are being dispersed. There's a lot of checks to be written. That attorney has a lot of checks to write. Who all is involved in a typical closing that needs to get paid? Well, besides the seller and the agents, we have inspectors, appraisers, surveyors, warranty companies, the Register of Deeds office for recording the deed, the lenders, that's the big one, right? A lot of loan fees. The lender's getting lots of different fees that they charge along the way. So all those funds need to be paid out. And the attorney is who is the quarterback for all of that stuff. They're the ones sort of pulling it all together and handling all that stuff. Best way to terminate a contract and agency agreements, what we're talking about in this entire chapter, the closing, because everybody's getting what they originally set out to accomplish. Seller's getting rid of that property for consideration, money, something of value. The agents are getting paid. The buyer's getting the keys. We've talked about this already back in chapters 9 and 10, the difference between settlement and closing. What is the difference? What are some differences between settlement and closing in your own words? There you go. That's some good stuff. People versus paper. Closing is recording. That's when the closing happens, is when that deed gets recorded. The settlement is when everything is signed. Closing, theoretically, officially, is when you're cleared to get the keys, although the parties could decide otherwise. But yeah, for the most part, that's what makes us less nervous as brokers. We'd rather keys not be given until money is cleared, given to the seller, but it's up to them. So settlement is executing those documents to transfer the property and delivering them to the closing attorney. Signatures being captured, being accomplished. Closing is when the deed's recorded, the buyer gets possession, the seller gets the funds, and then we get our commission. And for the most part, that possession and the keys to access the property happen after the recording of the deed, after that closing has happened. But again, the parties could decide otherwise. If the seller wants to be cool and laid back about it, they could say, I'm pretty confident everything's going to be fine. We've all signed the paperwork. We haven't closed yet. It hasn't been recorded, but it's only going to be within an hour or two that's going to happen. So yeah, buyer, you go ahead and here's the keys. A lot of times builders will do this. They'll go ahead and release the keys because they know, they're real confident there's nothing else that's going to go wrong. What could go wrong? What's something that could go wrong that could delay the closing even further? Well, let's think about the activities that are happening, the tasks that are taking place between the settlement and the closing. Everybody's signed everything. The attorney, via the paralegal, is going to scan all those places, all those papers that got signed, send them up to the lender, the loan documents, make sure the lender's okay with it and everything got signed and initialed. The lender's then going to authorize the release of that big old giant loan balance or loan amount. They might have already wired the money to the attorney, but the attorney's not allowed to release it to the seller until the lender has given their final okay. Lender could say, oh, you missed a page. We need to get that signed before I'm going to authorize the attorney to pay the seller. Go ahead and record the deed and then pay the seller their check. So that lender's got to make sure all that looks good. Then the attorney has another thing to do. The attorney goes to the Register of Deeds and says, they do an updated title search. They make sure there's no additional liens that have been added since when they checked a week or two ago. That's the big one. That's why keys shouldn't be given until after closing, because it's only until they've checked the liens one more time and then recorded that deed, now it's safe. And we'll get notification as brokers. We'll get an email usually from a paralegal that says, we are on record. It has recorded. Your seller can get their check. You can get your check. The buyer can get the keys. It is safe. It's all done. It's executed. We are no longer executory, right? They don't say that word, but we know what those words mean. What's happening during that due diligence process? Well, a lot of things. We've got the attorney doing the title search. We talked about the title search. We've got the buyer agent helping the buyer figure out and schedule and probably show up for the inspection, maybe. Although today I'm a listing agent for this transaction. I went there to talk to the appraiser to make sure that he gave a proper credit for what the house had to offer. And the inspector was there because they both arrived around the same time. That's not typically the case. They go on separate days, just happened to be that way today. And at that point, the buyer was not there, nor was the buyer agent. They don't have to be. When it's me and I'm the buyer agent, I like to show up for the last 15 or 20 minutes of the home inspection because I want to get a heads up of what are we dealing with? What did you find? Oh, you found some mold down in the crawl space. You found evidence of a past fire in the attic. You've got maybe some bad siding, some rotted wood siding. Let's go ahead and a good inspector is going to flip through the pictures they took. They're not going to make you crawl up under the crawl space. They're going to say, see here's the picture I got while I was under there. And then I can give my buyer sort of a heads up. In a market like this, if we think the seller's less likely to fix things, I guess it's a little less crucial, but I just like to know things sooner than later, right? And they might have shown up. I didn't stay the whole time. I just went there to see the appraiser and I left after we had a little talk. But that inspector was still there and probably was going to be there for 2 or 3 more hours. That house has a lot of work that needs to be done. Is the seller going to do it? They don't have to. We could probably put it back on the market and find another buyer. So whether that buyer asks them to fix stuff remains to be seen. And then it's a question of, will they fix stuff? So we're investigating the property. The buyer gets to have anybody look at it they want to. They can get the opinion of their not a home inspector uncle from Arizona who's never been to North Carolina, but he built a doghouse 20 years ago. It doesn't matter. They can back out for any reason or no reason. We, as their broker, need to go on record and say, look, I can appreciate your uncle probably knows all about doghouses, and you can have them look at it if you want to, but here I am officially recommending we get a licensed home inspector to look at it also. Let's not stop at the doghouse inspection. Let's get somebody who's licensed in North Carolina. And if you don't want to do that, please sign here so that next year when you realize you should have, you won't come after me. I have proof that I told you should have. It's called Form 760, the Professional Services Disclosure. Saves you from having to pay for things that people claim you didn't tell them earlier. But the basic question here during this due diligence period is the buyer's deciding, do I really want to do this or not? And they may not want to if it come to find out requires $15,000 to do repairs. $15,000 in repairs between the roof and the crawl space and the water heater shot and the blah, blah, blah. Maybe the buyer says, well, it looked good to me 3 weeks ago when I made the offer, but now that I've had the inspection, I don't want to pay this price at this current condition. I'll only continue forward and pay this price if the seller's willing to fix X, Y, and Z. But does the seller have to fix it? No. In a market like this, quite likely they won't. Then the buyer has a question, a decision to make. Are these items that still need to be fixed worth me walking away from that due diligence money? Because that's what they're doing. If they decide not to buy, we're going to walk away. And what could that be? It could be $100,000. If you put down $100,000 due diligence, you're basically telling the seller, you know what, you don't have to fix anything, because I doubt a seller's going to fix anything. That's not the norm. It's kind of settled back down to more of a $2,000, $3,000, $5,000 due diligence, maybe 10, depending on the price point. But there are still some crazy ones, depending on how competitive and how many offers come in on a certain house. And that's all they're trying to do. Do I want to keep going or not? And that due diligence period within which they need to make this decision determines, are they getting their earnest money back or not? So that's why they want to do all the examination, inspections, thinking that they need to do while they could still possibly get that earnest money back. It's a lot of work. It's really the most important part of that transaction, second to the closing day itself. Time is of the essence. It is actually 5 p.m. on the date that you've put in as the end of the due diligence deadline. And so if it's looking like that buyer can't get everything they need as far as information, including what the seller's willing to fix by the 5 p.m. deadline of due diligence, then they need to either be willing to terminate because they don't want to buy it unless they can get that extra information, or negotiate repairs. They don't want to buy it in its current condition, or move forward, but just know that if they back out later after the due diligence deadline, now they're going to also lose the earnest money. Could be another several thousand, right? Also, what's happening? Who's picking things? Mostly the buyer's picking a lot of things. The buyer's choosing the attorney, usually. The buyer has chosen the lender. The buyer is hiring inspectors and the surveyor. Those are probably going to be recommended by you as you meet more of them over time. You know good ones that are what's a good one? What's a good inspector? Somebody that calls you back. Somebody that is responsive and will help a buyer and explain to them complicated things, and even contact the other side and explain to that seller and listing agent why this thing is a problem. But there's a balance. Some inspectors are better than others, like brokers and lenders. But some inspectors just are so skittish about every little thing that's wrong with the house that they are what you might call a deal killer. They write too many things up in too scary of language. So you want to strike a balance between full disclosure and not being an alarmist, right? A lot of those home inspection reports are worded very CYA. Cover your assets. The inspector says, I'm no mold specialist, so you probably want to get a mold specialist, because what I'm seeing is evidence of fungal growth. They don't even use the M word. I'm seeing evidence of termites or wood destroying insect, or soft wood, or baseboards that are kind of crumbling. They poke a screwdriver in it, literally, to prove that it's not sturdy and solid wood anymore. But you need to have a specialist look at it. And sometimes they also do that separately. So you could get an inspector that will add on the termite inspection. They'll add on a radon inspection. They'll add on, I don't usually see a mold person who's also a general inspector. They usually do one or the other. But that's the time to do it during this due diligence period. And schedule it early enough so that the extra level of inspections still has time to take place. Survey. That's important because it reveals encroachments. And your title insurance policy, listen to this one, will not cover encroachment problems later if the buyer didn't get a survey done when they bought it. Let me say it again. If there's an encroachment problem that comes up later, your title insurance policy might help you pay for it and solve it, but only if you had a survey done when you bought it. Why? Because if you have a survey done, the title company is going to know that there's probably no problem early on, and they're going to be much more willing to pay for something that probably is not even going to ever happen, right? So you just as a broker need to say, look, buyer, you need to get a survey. I don't want to. I just paid for $3,000 worth of inspections. Okay, fine. Then sign here. So next year, if you decide that you should have gotten one, like I'm saying you should, you won't come after me for it and whatever damages you might have to deal with. Because it turns out the corner of that detached garage is 3 feet over the line, which we won't find out without a survey. So let's get that done during the due diligence period too, so we can discover the encroachment, and that can be negotiated. What happens if there's an encroachment? Driveway, fence, building is over the line. Well, now the parties can negotiate it. They can say, let's maybe redraw the line. Do we have time? The neighbor might be willing to sign off on something saying, yeah, I'm okay that some of your building comes across the line onto my property, or some provisions have been made. Let's see. Question. City already has records. Does that still? Absolutely. What the city has is worthless. That's all usually based on tax stuff. And those dimensions that you might see on a tax record or realist or any sort of tax version is just total guesswork and conjecture. You, as a broker, for your own good, of sake of your license and your client's best interest, official survey, paid. It's going to depend on how big it is and how hard it is to access, because if it's heavily wooded and they have to go through a bunch of trees and shrubbery and bushes to fight off bears and all that, and it's 3 acres, it's going to be more, right? Typical neighborhood lot survey might be another $500 or $600, but something with acreage and some hard to get to areas kind of situation that takes longer, partially to 1,000, 2,000, could be all kinds of stuff. But yeah, you as the broker always want to recommend everything, survey, inspection, everything. And if they refuse, get proof in writing that they refused and you suggested it. But they do still need it. Homeowners insurance, good time to shop for this, by the way. One time, my client called me and said, I've been shopping for homeowners insurance. I talked to my current insurance company, and I believe it was State Farm, if I remember correctly, and they were giving them this ridiculous quote that was super expensive. And I said, well, let's talk to some others. And they did, and it was like almost double everywhere else. And some point later, I met a State Farm person, and I said, I'm just curious. I had a buyer recently who was shopping for homeowners insurance, and you guys were like really excessive. And they said, yeah, we didn't want to write any homeowners policies for a couple of months because we had so many. We wanted to balance it out with auto and motorcycle and whatever else. So we just were like, if you want to pay our high price, we'll take you. But we'd really just rather not even write it. It was their way of discouraging people, because they wanted to kind of regulate and even out their policies. So that's a thing that could happen. Usually best advice to your client, get 3 quotes, 3 to 5 quotes from whatever. The roof guy, the siding person, the plumber, the insurance company. Another one for insurance is to tell them, talk to your car insurance provider. Maybe they'll give you like a better deal because you've got both your policies with them. Car and home. So we're going to talk about insurance in its own chapter. It's a little 30-minute chapter we'll get to later. But what if the insurance policy for some reason comes back, the annual premium comes back a lot more? One area that this could happen is if it is what? You tell me, what could come up with regard to insurance that could add more than they're willing to pay? There it is. Victor gets right to it. Flood insurance. Yeah. I had a listing years ago in a flood zone. Seller told me, full disclosure, they told me, I told the buyers, told the whole world. They were signed up to this special North Carolina subsidy program. And so normally the flood insurance would have been $3,000 extra a year on top of the normal house insurance. But because of this flood premium, or subsidy, it was only like $30 extra or something significantly less. And so if that buyer had applied, looked for insurance, knew they needed flood, and they shopped around, and maybe that subsidy program was no longer available, and now they find out they've got to come up with an extra $3,000 a year, that might be a reason they need to not choose to buy that house, right? The buyer who actually bought it was an agent. She was buying it for herself because she already owned property it backed up to. Every couple of years, she'll post on Facebook and show pictures after a heavy rain, and she got flooded out again. It doesn't get into the house usually because it's like 5 feet above the ground surface, but she does have her heating and air unit in the crawl space, or she used to. I would have moved it by now. But that gets wiped out every time. And I don't want to deal with that hassle, but she's okay with it. She just goes through the process of making the insurance claim, but all that needs to be figured out when the buyer still has the ability to walk away and get their earnest money back. There's no loan contingency. We know that already. It's not an automatic built-in thing. So if the buyer can't get their loan, they're still going to lose their money if they choose to walk away. Which money? Depends on when they walk away. If they walk away within the due diligence period, they're walking away from due diligence money. That's going to be gone regardless, pretty much for almost any reason. If it's outside the due diligence period, which, by the way, it frequently is, by the time we find out the loan has been approved or not, we are outside the due diligence period. And if that's the point at which the buyer chooses to walk because they have no other choice, they can't get the loan, they're walking away from earnest money too. So, best practice, have enough due diligence period time that hopefully you could at least get a conditional loan approval from the lender. Conditional loan approval pretty much is the lender saying, we've looked at everything, and as long as they stay alive and show up to closing and don't buy a car between now and then and do anything significantly affecting their credit score, we're going to give them the loan. And that's when you lock them in your basement and don't let them out until closing day, right? A justified kidnapping when it's about a closing happening, right? And if that buyer can't get financing, they find this out within the due diligence period and they want to make sure they get that earnest money back, they need to send in written notice of termination. Hey, you know what? I couldn't get the loan. I want to back out. I know I'm walking away from the due diligence money, but I don't want to walk away from the earnest money, so I'm backing out by 5 p.m. In writing, there's a form for that we would help them provide to them, get signed by them, and pass on over to the other side. What's the buyer looking for? All these things, zoning concerns. What are they allowed to do with it? Government regulations, flood hazard areas, utility and access. What kind of utility? Like for me, I'm going to want to buy something with high-speed internet, right? So I'm going to be looking for that. I'm going to try to shop for it. And as soon as I find something that I like the looks of, I'll make some phone calls and see if I can find out. That's probably going to be the biggest pain in the neck of my process for when I'm buying something, because they sure don't make it easy. AT&T, Google Fiber, nobody just gives me a map showing here is the area where we offer services currently. It's always a sales pitch. It's usually, no, we don't offer it there. Streets and roads. What are we talking about with streets and roads that could be a concern? Huge. Sheena says private versus public. That's it. Because if you're sharing a private road with 20 other neighbors, you all are going to have to pass the plate and come up with some money to repave that road when it comes due 10, 15 years from now, repair some potholes. That is expensive stuff. So just make sure they know what they're getting into. Look for that. Look into it as the broker. Is this publicly maintained or not? Fuel tanks, they need to discover, is this an underground storage tank? Was there an oil tank buried in the ground somewhere? Septic system inspection, huge. Wood destroying insect, another way to say termites. There's also carpenter bees and powder post beetles. Anything that eats wood could lead to structural problems. That wood destroying insect report, WDIR, what does it report? What they like to ask you on the test with this is, it reports if there are any wood destroying insects that the inspector can see without moving things around today, on that given day. They could pop up tomorrow, the day after he went out there. But also they have a big fat liability coverage disclaimer in there that says, I couldn't see everywhere because you had all kinds of stuff pushed up against the garage walls. And one of the big places that termites, for instance, come up is between the garage slab and the garage wall. It looks sort of like this. I think I shared this with you before, but as a little recap. There we go. So anywhere that there's, particularly in the garage, you might see something looking like that. Just a little dirt tube. And those termites are traveling back and forth in that tube because they don't like the light. They're creating these tubes. Now they can get in between the crack between the floor and the wall through that tube up to the wood. And if it's a wood leak or a water leak situation, now they've got food and water available in that spot. So they might be, every time you see mold or rot, you might also see termite damage. And if you start poking around in there, not that you should do it, but the inspector does it, the what looks like a solid baseboard could actually flake away or poke all the way through. And sometimes you see them squirming around in there, and now that's called an active termite infestation versus a previous termite infestation. Anybody getting itchy yet? So that's a thing. This one's been not noticed for a while. That's a big old series of termite tubes. So that inspector is looking around for that evidence. And can they see it in a really packed garage? No, not often. And they're not authorized or willing or allowed to move things away from the wall to look for that. They can just look for what their naked eye can see. Another disclaimer in that report is that, hey, I couldn't see behind the kitchen cabinets. Here we go. Because they're not expected, and we don't want them to pull the cabinets up, but there could be termites back there. And here's basically what it looks like. North Carolina Wood Destroying Insect Information Reports, where the parties' names go. This is the area where they couldn't get to. Areas that are deemed inaccessible or obstructed, they'll often say. Kitchen cabinets, garage walls because of the belongings. And they're reporting these things. Revealed visible evidence of subterranean termites. Did it look like control measures had been performed? Were they treated for? Did they do what you have to do to treat for termites? Do you have evidence of this? And one of the control measures when you're treating for termites is little holes in the concrete slab all around, because that means they drilled down 18 or 24 inches, the termite company, and they squirted in the killer, the insecticide, the termiticide. Then they filled those holes back in with like a concrete sealant. So you can see those little dime-sized holes across the front porch floor next to the house. That's a treated, probably signs of termite treatment. And that's what these termite inspectors looking for. Or it doesn't look like any measures were performed, or visible evidence of a previously treated infestation which now appears to be inactive. Check the box. Or was it powder post beetles or old house borers or anything else? And then down here, the one you always want to see is nope, no evidence of infestation was observed. And then explanation if you needed. And then let's see if I can, where's page 2? See if I can find a page 2. Maybe this. I'm looking for... Yeah, they might have some version of this. Where could you not look at it? What were things that were inaccessible and obstructions? And so somehow or other they'll disclose I couldn't see in these areas. So that's what the termite report is good for. What does it report? What they could see from the naked eye on that day. What does it not report? No guarantee that there are no termites. They will never guarantee the presence, the lack of termites, because they can't see everywhere. So look out for that. They will never say there are absolutely no wood destroying insects. I guarantee it. That'll never be in that report. Okay. When are negotiations completed? Well, during the due diligence period, hopefully we've had any inspections that were wanted to be done. The general home inspection, by the way, probably about $400, $500, $600, probably more like $600 or $700 nowadays. Add-on inspections like termite, radon, mold, and the results of all those reports are back. Now you, the buyer agent, read the report along with your buyer, and then you talk about it. Hey, buyer, what do you want to ask them for? Maybe nothing. Maybe you don't get away with anything because they're just go to the next one. Maybe your buyer promised not to ask for anything as part of their offer. They still wanted the inspection, so they would just know, because they might discover something bad enough that they don't even want to buy it, but they've already told the seller they're not going to ask for things. That was part of the deal. Maybe in this kind of market. But if they do want to ask for some things, you're going to help them figure that out. Hey, we're kind of looking for items in need of repair. The fact that the roof has 10 years of life on it and you want to ask for a new roof, probably not going to fly. But the fact that some shingles are broken and water's getting in now, that's in need of immediate repair. That's kind of what we're focusing on. And those negotiations need to be completed by when? The time that they could still walk away and get their earnest money back. Yeah, due diligence deadline. Now, what if you've done that? The seller said, sure, I'll fix 3, 5, 7, and 9 from the inspection report. They sign it. Your buyers sign that they want that, and the sellers sign that they're willing to provide that. Do those things need to be done and fixed during the due diligence period? Do the repairs need to be completed during the due diligence period? No, just the promise. Just the promise in writing. It'll be used, we'll use a form called a due diligence request addendum that says, we want you to fix these items from the inspection report. The seller says, no, I won't fix those, but I will fix these. And they work it out and sign it. Now you have what you need before the due diligence deadline. Now the seller needs to get those things fixed before the closing. They have all the way up till the final walkthrough to get those things fixed, just before the settlement. Seller's choices when they are presented with a list of repairs to be done? No, they could just say, I'm not fixing anything. You guys free to walk, leave that $10,000 check that you already gave me, and I will collect another one from the next buyer that might probably not even ask me to fix anything. But their time is coming. There will be a time when it gets to be balanced again. The seller's just as worried about the buyer leaving as the buyer is about the seller fixing things. And then probably the complete opposite lopsided, maybe not to the same level, but there will be someday, who knows when, that it's a strong buyer's market, in which case the seller will be fixing everything on the report and putting whipped cream on top and offering to pay their car payment or whatever. All of the lopsidedness helping the seller right now, flip it to help the buyer then. That's coming someday. It won't be next year. Might not be in our lifetime, but it'll be in some amount of time. It's all cyclical, isn't it? So the seller can agree to fix stuff. They can just flat turn it down or somewhere in the middle. Meet somewhere in the middle. Yeah, I'll fix these things, but not those things. Let's go ahead and take our break. See you back here in 10. All right, welcome back. Okay. So what do we have here? After those repairs are done, hopefully if they're done, before that closing happens, we need to have a final walkthrough. In fact, if repairs are negotiated, the best course of action, really, let's not wait for that final walkthrough to discover if the repairs got done. Because here's a very real world scenario. You schedule it for the morning of closing. You show up at 8:30 to walk through. What's the purpose of a final walkthrough? Making sure the house is pretty much the way it was when they decided to buy it. They didn't make a bunch of damage when they moved out, or they picked up a rug to reveal this big hole in the carpet or the floor, or move furniture to reveal something. So just making sure your buyer's getting what they expect that they're getting. And nothing was done since then. But if you do that final walkthrough the morning of closing, you got to get to closing by 11, and you show up at 8:30, and the seller is supposed to have replaced 4 windows because of they're foggy. They've got the broken seals and a couple other things, only to find out, oops, they didn't fix anything. What is your leverage? What is your client's leverage as a buyer? Well, they could choose not to buy the house, but they have probably maybe sold and closed on the one that they had to sell in order to buy this one, so they're homeless. They've put all their stuff on a moving truck, and now if it doesn't close today because you're going to hold out and not sign the papers because the seller didn't fix things, well, that means the movers are going to have to move it into a storage unit, then put it back on the truck, and then bring it out. They're paying for 2 moves. Can they get that from the seller? Not immediately. If the seller doesn't agree and they have to sue them, now that's going to be later. So, and your buyer's loan was approved to close today. If we don't close today, they might also involve a rate lock extension that the seller may or may not pay for. The lenders, even if it closes tomorrow instead of today, the lender's going to have to redraft the documents, and that might require it takes longer than tomorrow. Also, can the attorney even fit you in tomorrow? Because guess what? Their time slots fill up too. A lot of problems. So when repairs need to be verified to have been fixed, and I get word from the other agent that they were all done, I want that to happen a week or so before closing at least. I'm going to get out there myself and advise my client to pay for the inspector to come out and look at it and verify that it was done properly. But at the very least, I'm going to go so that we can say, hey, seller, I'm sorry. I know you missed it. You probably just didn't understand or realize it's no big deal, but we need these things fixed. They can't hold your buyer hostage anymore because you only have an hour to fix things before closing. Let's not let that happen. So final walkthrough would then again happen after, before closing. It might be day before, it might be morning of. And you're looking for things to be pretty much the way they are expected to be. Were they going to leave the chandelier or take it? Make sure that's done properly. Were they going to leave the pool furniture and the little mini building out back? Make sure they did. It's time to verify all these things. But again, I'd rather have verified all that even earlier so that we have time to fix those things. Seller can't just say, oh, I'm so sorry, it's already on the truck to Michigan. And you don't have to worry about sellers and gift cards. And, well, then you've got the buyer's lender, because the buyer's lender doesn't want the seller to give the buyer any money, even to solve a problem like that. Because that could affect, can they really afford it without the seller? And then you got to get lender approval. It's just a big hassle. So that final walkthrough needs to be as boring and low-key as possible. All right, let's make sure things are done early so that our final walkthrough is nice and smooth. A lot of this stuff needs to be done during due diligence, because once it's over, now the buyer can still walk away. So if the test question says, can the buyer walk away after due diligence period? Yeah. It's just that now they're going to walk away from the earnest money also. So that's what's in play. What is the seller caring about and working toward during this process of being under contract? Well, they're most worried, can the buyer actually do what they promised to do? They're going to as a listing agent, you're going to check in and say, how's that loan approval process going? Everything going well? Any questions? Oh, no, we didn't get approved. Is that a dead deal? Not necessarily. Maybe another lender can pull it off. But let's figure that out sooner than later. And then other than that, the seller's just concerned with, did all the contract terms get completed, get fulfilled? Did they do what they promised they're going to do? And that's what the seller side is looking for. The attorney's doing this. The paralegal actually is filling out the settlement statement. There's some things required from the seller. Seller needs to verify and sign off saying, I've not had any work done to the property that I have not paid for. What are we talking about there? The seller will sign something saying, I promise I've not had any work done that hasn't been paid. And the attorney's going to require that because they're looking for evidence of any mechanics liens that might be coming up along the way. Oh, you didn't pay for some roof repair? Then let's go ahead and pay for it so they don't put a lien on the property that we have to deal with, and then we'll hold up the closing. If there's any sort of bill of sale for that patio, pool furniture, that shouldn't be put in the contract. The lender won't allow it. If you're getting a loan, the buyer's lender is very particular of what you can include in that contract. And at most, they might be okay with a washing machine, dryer, and a dishwasher. And a refrigerator. That's about it. If it's a bunch of furniture or even a desk and a couch, I've had them throw it back because we put in a sectional couch and an L-shaped desk. The buyer's lender said, we don't want to see that in this contract. You're going to have to deal with that some other way. And the way you deal with that sort of personal property is with a bill of sale. We can't draft it as a broker. We can't draft legal documents, but we could go to that closing attorney and say, hey, guys, do you have a standard bill of sale template contract kind of thing you could provide us? And they might. Or they might say, no, but we'll draw one up for you. Just a basic, hey, for $1, I'm going to include this stuff or whatever they need to do. To make sure that the buyer's confident that those things will be left behind while still accomplishing the goal of the lender not wanting it to be in the contract. Because the lender wants to loan money to buy the house. They don't want to loan money to buy a room full of furniture. The attorney's going to ask the seller for their current lender's information. In fact, the way it works is the attorney sends out an information sheet to the listing agent, an info sheet, and also one to the buyer's agent. So the attorney, there we go, is doing their title search and this and that and the other. They're going to send out a request for information to the buyer agent about the buyer and to the listing agent about the seller. And for the seller side, that's going to be, hey, current loan, who is it with? And get the seller to sign a permission form so we can contact that lender and find out that final loan payoff so that we can arrange for it and collect it and send it to them. Send that final loan payoff because you're selling the property, which triggered the due on sale clause. Any sort of leases that might be in place for the property, bill of sale that we talked about, and then the mechanics lien thing and no work undone, unpaid bills for the last 120 days. Not a lot of things. A whole lot less than the buyer's side is going to have. So that info sheet is going to ask for all these things plus the social security numbers of the owners. Again, both of them signing the loan payoff permission form. And HOA. They want to know HOA information so they can arrange the settling up of those dues. Maybe the seller hasn't paid this quarter's HOA dues if that's how they collect. And then any sort of outstanding invoices again, that kind of goes back to any repairs that might have been done. On the buyer side, they're going to ask for invoices that might be out there. What else? They're also going to ask for both parties if there's anybody not going to be there, so they can make arrangements otherwise. If the buyer can't be there or anybody, what are some choices? They could give power of attorney to another party, maybe the other spouse or the other owner or the other person that's going to buy it, or that could be the sellers dealing with it that way. They could also do a mail away, meaning the attorney's going to draft the documents, FedEx them to the person wherever they are. They're going to have to go find a notary and sign in front of the notary and then send them back. And all that would need to be done ahead of time before the closing day. So there's a lot of little intricacies of what's going to go down and how to handle the logistics here. The buyer documents are certainly going to include the loan documents, title insurance, property insurance. For the property insurance, your buyer's going to shop. We talked about maybe check with their car insurance provider or previous homeowner's policy. Talk to the insurance agent, and that insurance agent's going to say, well, what's the house like? How big is it? What do you want me to do? They're going to create what's called a binder, and they're going to send that over to the closing attorney. Who you're closing with? Who's that attorney? I'll send it to them. And that insurance agent's going to send the binder document, basically a document that outlines the insurance, so the lender can make sure that they're happy with that the insurance is adequate coverage, and that attorney's going to add that into the list of things to sign off on, and the lender to verify that they're happy. Maybe the wood destroying insect, it's not usually required by the lender, but it could be, but it should be done anyway. And then the survey, a lot of times on that information sheet, the attorney will say, hey, buyer agent, does your buyer want a survey? And if they do they want us to order it for them? Some attorneys will do that, some won't. So now's your chance to tell them how you want to proceed there. Title insurance, we talked about that already. That's going to show up on the settlement statement as one entry. And it's not a recurring monthly. It's just going to be, there's a borrower policy that covers the buyer, borrower, new owner for the amount the property's worth forever. And there's a lender policy, and that policy is going to die over time. It's going to decrease. The coverage of that lender policy doesn't need to be for the purchase price the whole life of the loan, because the loan amount doesn't stay the same. And as that loan amount decreases, the coverage decreases over time until finally the loan's paid off and the coverage, the lender policy is no longer needed. Now, all of that is handled by the attorney. The deed must match up with what the contract says, because that's where the lender pulls the information from. Not the lender, the attorney. The attorney makes the deed based on what they saw in the contract. The attorney's already done the title search, investigated the history, issued that preliminary opinion that the title is clear, and then based on the attorney's opinion, the title insurance company is going to say, okay, sure, we'll insure it. We will write the policy. Conducting the closing. Who decides when and where? It's really the buyer usually, but it's somewhat negotiable. The seller might have something to say about it, but if the seller counters the closing date, that's still a rejection. It's not just about the money that constitutes a rejection of the offer. So you want to make sure you counsel your clients, look, are you really sure you want to bump the closing date up on this offer? Because that's going to kill what's here. And the way I handle that, if that's a concern, I will reach out to the other agent and I'll say, this is not a counteroffer or a rejection. We're just curious. Would your client be okay with closing on such and such day instead of what they suggested? If not, we'll go along with it. I don't want this to kill what we have so far. So you might want to counsel your client there and handle that very carefully. Don't come across don't let it sound like a counteroffer if it really is not. But the buyer chooses the attorney usually. One time when the buyer might not is if they're buying new construction, and that builder might say, well, I'll give you X number of dollars toward your closing costs if you use my approved attorney that I prefer. Why? Because that attorney already did a lot of the work for the property, the development. And so it might just be easier and smoother to use the same attorney, but that's still your buyer's choice. Your buyer could say, well, I don't want to do that. And then the builder incentivize them by paying them money toward closing costs to do it, but they could still say no. In which case, most of the time they just go along with it, but it's ultimately officially the buyer's choice of the attorney and when and where, day and time. And by the way, it could be that the seller does not show up to settlement. They could sign the handful of documents they need to sign, which is like 4 or 5 things, not very many. A day or two before, a week before, long as the attorney has time to prepare those things, most of that can be handled on a different date than the settlement date. You might have heard in some of these HGTV shows mention of close of escrow, or you might have come from a state where you handled it that way. California, I think, does it that way. And that's just the way they do it. We don't do it that way here. That means an impartial third party is handling the closing. But again, remember, in North Carolina, everybody represents somebody. So who's handling the closing in North Carolina? The settlement attorney, the closing attorney, and they officially represent the buyer and the lender. There's a couple of things they'll do on behalf of the seller, but the seller doesn't really need to have their own attorney unless they just want to. So the attorney's representing the buyer and the lender's best interest. So if your seller is just adamant about it, I want my own attorney looking at this, that's okay. What's going to happen is the thing that the attorney needs to do for the seller is the title search. The deed preparation, the preparation of the deed. The attorney will prepare the deed. And so if they want their own attorney to do that, that's fine. They'll do it, and then they'll send that prepared deed over to the actual closing attorney and bill them and say, hey, you just need to send me a couple $100 for preparing this deed. It might be $200, $300, $400, by the way. Tends to be what a deed prep cost is. So for this class, for this course, for this test, who pays for the deed preparation? The seller. Seller's paying for deed prep. And I remember it this way. When you sell your car, what do? You wash it, you detail it, you prepare it for sale. And you pay for this. You're the seller. So the seller of the house needs to pay for preparing the deed. Because they're the one who's going to sign the deed over anyway. So however you need to remember it, that's how you do it. And typically that closing attorney just handles that little bit that needs to be done. But does it have to be an actual attorney that points to the blank lines and says, hey, buyer, hey, seller, sign right here? No. An attorney in North Carolina is not required to tell them where to sign. Who could conduct that settlement meeting? It could be you. It could be a person who calls themselves a settlement agent. The only caveat there is if you use a non-attorney to handle a closing, they need to have a way to reach an attorney to answer any legal questions that might come up. In almost every closing, some sort of legal question comes up. So it's a little annoying, but it's not impossible. And there's I wouldn't do it as the broker involved, and I've never done it, but I have had several closings where the buyer chose a settlement person who was not an attorney. One time we met in an Asian restaurant, and we just sat around the table and signed the papers just like we were in the law firm. And somebody had a legal question, and so that facilitator person, that settlement agent non-attorney, had to call the attorney of record and say whatever the question was and get the answer. So we just had to wait there. Much better to have an attorney who can say yes, yes, no, here's the answer. But it's a possibility. And not only here are the parties not required to attend settlement together, frequently they don't. And they're not they're not wanted to, especially as a result of that thing that happened in 2020. We handled closings a whole lot different. We even would have paralegals come out to the parking lot, and the client would drive through, and the paralegal would hand them the papers with a 10-foot pole, maybe not quite like that, but everybody was adequately protected. And I would still go. Sometimes they would say, "We don't want you to come. Do not come. Agents don't come." And I would, get something signed so the client understood, here's what's going on, special situation, but you better believe I made sure all the documents were right and matched up before they got signed, and maybe even FaceTime along the way. So whatever it needs to happen. But we're back to real life. Frequently, the seller will show up, the buyer will show up, and the seller will go in first to the conference room, and it's just the seller, their agent, and the closing attorney. And they sign their handful of things, probably takes 15 or 20 minutes, depending on how many questions they have, and they're gone. They leave. They might leave behind the keys to the attorney for safekeeping, and the attorney doesn't release them until the deed has been recorded. They might have already made key arrangements between the agents, and then the buyer is brought back. And if they have a loan versus cash, it's going to take longer. 45 minutes to an hour. Again, it depends on how many questions. But then once that settlement signing appointment is done, all the signatures are done, again, nobody's getting keys or money right away. It might be a couple hours before all of that is finalized and approved and verified and deed recorded, and now here's your money, here's your keys. But they don't have to attend together. It used to be that they would. Most of the closings we would do up until several years ago, the seller and their listing agent would be on one side of the table, the buyer and their agent would be on the other side of the table, and the attorney's at the head of the table, which was a little weird sometimes if the seller stayed the whole time, because we're talking to the buyer about their new payment, their loan amount, things that really aren't the seller's business. Here's a big one. On the test, should the brokers attend the settlement meeting? Absolutely. Will it be boring? I hope so. Will there be anything for you to do? Maybe, but probably not, and I hope not. But I've had several closings where somebody said, "Hey, we need this document." I don't have it. Do you have it? And I was able to scroll through even just on my phone and find it in a Google Drive or find it on my signing software and pull it up and email it to the paralegal. And 3 minutes later, they had the document printed, ready to be signed, and we didn't have to come back later. We could get it all done now. So we can save quite a bit of hassle. And the commission says this is part of your responsibility and duties. You can imagine out of 84,000 licensees, there are some lazy ones. And if they could get away with it, they'd rather, because there's really not much for us to do in a perfect situation, they'd rather be out writing another contract, showing houses, getting another sale, getting another listing. But here's the commission's stance on it. You need to go to closing. This is top priority. Negotiating, getting listings, and showing up to closing. That should be what brokers do. All that other stuff could eventually be delegated to someone else, safely and not ticking off or concerning the real estate commission, but at least show up to closing. You've violated your fiduciary duty if you don't. So that closing constitutes verifying all the promises were fulfilled. The buyer's loan, if there is one, is finalized. Those are the two big issues that we're accomplishing during this settlement and closing process. And again, the North Carolina Good Funds Settlement Act says no dispersing of the money until the deed has been recorded and the deed of trust has been recorded. These are the two documents that get recorded. What's the deed of trust? What am I talking about when I say deed of trust? One of those things you sign in order to get the loan, but it's specifically the thing that does what? What is it accomplishing, this deed of trust? Yes, perfect. it's putting that property up as collateral. So you're acknowledging to the lender and to the whole world that this is the mortgage, for lack of a better word. The better word is deed of trust. And if I don't pay, I don't stay. That gets recorded. You could look up your neighbor's deed of trust right now. Just go to the Register of Deeds website for your county and look them up by name or address, and there it is. So the deed gets recorded, the deed of trust gets recorded. Does the contract get recorded? We're all done with it. It's going to be an executed contract, and it's nobody's business except the parties involved, so no. Contract does not get recorded. The agency agreements don't get recorded. Just these two things, deed and deed of trust. And they must be recorded before the funds are released. They might be recorded. The keys might have already been released before these things get recorded, by the way. Don't forget that, but not ideally. We'd rather not. We as brokers would rather it be keys for money. But definitely not the money. There is no exception there. That is because of the North Carolina Good Funds Settlement Act. Let's make sure the funds are good before we pass off the deed and the keys. All right, make sure that everything's going to go through successfully. So there's what's happening after that settlement. We talked about it already. The title is updated one more time. Any other liens that have popped up in the meantime are handled, titled. The deed gets recorded. The deed of trust is recorded. The seller's liens are canceled because they got handled and paid off at closing. So any other liens that were dealt with are all done, because now the attorney is going to write the checks and send those in to pay those liens. The funds are dispersed to the seller and to the brokers and to the other entities, maybe inspectors and repair people and whatever it could be. And this one, another document that gets signed is telling the IRS that a sale happened. So we got to submit that document. The attorney submits the signed form saying, yep, we had a sale today, sale of property today, so they can tax you accordingly. What is the document that shows all of these numbers? The document that reflects all of these various pluses and minuses for the buyer and pluses and minuses for the seller. If it's a loan, it's called a closing disclosure. If there's a loan involved, closing disclosure. Why do I say it that way? Because maybe it's cash. And closing disclosure is an actual official term. So loan, closing disclosure. Cash, it's going to be called a HUD-1. Either or both of them are called settlement statements. Let me do it this way. Both of them, are called settlement statements. Statement that shows the pluses and minuses handled at closing. So the settlement statement we're using when it's a loan for the purchase is a closing disclosure. The settlement statement when it's cash is called a HUD-1. And with the closing disclosure method, there's going to be a seller version and a buyer version showing pretty much the seller's pluses and minuses, and the buyer has their own separate one, just showing their own, so as not to tell either side stuff that's really none of their business. And so we're accounting for every single cent. The attorney is writing down, is showing for signatures and approval of all the parties, every dollar and cent involved. One of those is going to be the amount the seller's getting, the sale price. That's going to be the top of the page. And then the deed preparation fee the seller's got to pay, and the commission the seller's got to pay, and the loan payoff the seller's got to pay. Did I say that wrong? I meant the sale price is a credit, not obviously not an expense, but something the seller's getting. And then all those other things are subtracted from what the seller is getting, so that we end up with what the seller is truly walking away with. The sale price minus their various expenses. When it comes to taxes, the property taxes, how much does the seller have to pay and how much does the buyer have to pay? It depends on the time of year the closing happens. What day are we closing? And there's 3 possibilities that we'll get to when we get to the calculation side of things. And so it might be that the seller needs to pay some money toward taxes if they haven't already paid the bill. Or it might be that they've already paid the whole bill and they're getting some credit for taxes back because they're paid for the whole year, but they're not going to own it the whole year. They need to get money back for those last few months that they're not going to be the owner anymore because we're closing in like maybe say September, October, November, December. And we'll learn that later. But the settlement agent, closing attorney disperses funds from their trust account. That's where all that money is going to live until it needs to be written, checks written from it. And they're going to deliver the closing disclosures that are signed to all the concerned parties. Everybody gets an original, usually. Both agents, buyer and seller, and lender, usually. Wet signed or electronically signed original. We talked about RESPA a little bit, but we're going to deep dive more into that now and next time we get together tomorrow. But again, it's the Real Estate Settlement Procedures Act. It first became a thing in 1974. And it was, again, to protect consumers from lenders, making sure that they got accurate estimates for the various charges. And they did a better job recently than they did originally. From 74 up into the 90s, again, some of those, we didn't call it a loan estimate back then. We called it a good faith estimate. But the lenders would have different formats. They didn't have to have a uniform, everybody uses the same format. So it was harder for borrowers. And one of our jobs as agents was to help that borrower understand, wait, why is that rate so good? Oh, look back here on page 7. They're charging you discount points, figuring out so that they can compare apples to apples and really show this loan, this good faith estimate is different from that one in what ways? Is this a better loan or a worse loan proposal? So providing accurate estimates for settlement charges, eliminating kickbacks. That's another big RESPA thing that directly affects us brokers. For the most part, RESPA is about keeping lenders in check. But it does affect us brokers too, because here's the thing. Are you recommending an inspector to your buyer? You think a broker's typically going to recommend 1 or 2 good inspectors that the buyer might want to choose? Are you doing it because you know that's a good inspector, or because that inspector gives you $100 for every buyer you refer them? Not allowed to get the referral fee. That's called a kickback, and RESPA says not allowed. Brokers and service providers can't exchange money for bodies. In other words, you can't refer them to an inspector for money. You can't refer them to a lender or an attorney or any of the various vendors involved in a closing. RESPA doesn't allow it. And it's big penalties if you do. It's like a big deal to violate RESPA as a broker or a lender. RESPA also says, you know what? Well, the official phrase here at the bottom is it restricts excessive escrow account deposits. But that's like, what are we at, 9:15 at night? That does not make any sense right now, does it? So here's the thing. Let's think about if you were in charge of setting up how all this works. We talked about PITI. We know that's principal and interest, but that's also taxes and insurance. And we realize that if the tax bill is $1,200 a year, what is that per month? $100 a month, right? Is my math correct? It is 9:15 after all. So that means out of that PITI payment, the lenders want you to send in $100 extra for the T, and then let's just say another $80 for the I. And what are they going to do with that? Are they going to send that into the government, into the insurance company every month? No, it's not the way that works. These are going to be collected into an escrow account And then when the bills come due and payable, the lender's going to have plenty available, enough available to send those bills in. Now, what is that lender in the business for? Why are they in the business? Is it because they want to own a bunch of real estate and they hope that you get foreclosed on? No, they don't want your house. They want your money. And you better believe if they could get away with it, they would say, well, I know your taxes are only $1,200 a year, therefore $100 a month, but I want you to send me an extra $1,000 a month because I'm going to end up with $12,000 for the year plus another $10,000 for the insurance, and I want it to sit in my escrow account, which I will then combine with thousands of others, and that's going to be a significant amount of money that I can now earn interest on by investing in other places. But they're not allowed to do that because that would be ridiculous, right? So that's what we're talking about. They can only collect a certain amount for the purposes of this escrow phenomenon. The purpose of it is so that your bills can get paid for those two items, insurance and taxes, when they're due. So RESPA says, hey, lender, don't get any fancy ideas thinking you can make a side profit because you're charging a ridiculously high amount of escrow and making that account super big and earning a whole bunch of interest. By the way, it's sort of like if you win the $50 million lottery, right? Still live reasonably and stick 40 million or even 45 million into a thing that generates a reasonably safe offshoot of money, right? Now you're living off the interest, and that what's called nut is still sitting there unencumbered or unreduced. It's still there, right? So that's kind of what we're getting at here. The lender is not allowed to do anything else with collecting that money except have just enough to have a little bit of cushion, but then ultimately just pay off those bills when they're due. RESPA says that's the way that works. Regulation X under RESPA pretty much says RESPA rules apply to residential properties, single family, condominiums, townhouses, and that when it's residential instead of commercial, we're talking about up to 4 units or less. 1, 2, 3, 4, like duplexes, triplexes, quads. But once it gets to 5 or more units per, that's classified as a commercial property. So RESPA rules, like we've been talking about, and the Regulation X under it is for residential property. And look at that last line. It also says RESPA applies to anything financed with a federally related new loan. Now, reading that, thinking about that, I have a feeling to you right now, you're thinking, oh, does that mean RESPA is only for FHA and VA? Because those are federally related, and that is a reasonable conclusion to make. However, if you read the fine print, go into the details a little bit, federally related just means even the government oversight. So you remember, because of all that nonsense from 2008, the government stepped in and said, okay, lenders, you've messed this up royally. So we're going to keep our eyes on you. We're going to make sure that things are kind of done properly. The Dodd-Frank Act was one thing that came as a result of all that stuff. In other words, federally related includes conventional loans. When we're talking about this particular thing, RESPA applies to all of those loans too, conventional, FHA, and VA, because even conventional loans are federally related in that the government oversees everything. So just don't let that mess you up. Does RESPA apply to conventional loans? Yes. We talked about this already a couple times. The lender's required to provide the loan estimate, as well as a document called Your Home Loan Toolkit. Just a resource that they have to provide to that borrower within 3 days of applying for the loan. The Home Loan Toolkit thing basically just says, make your house payment or lose the house. It's just sort of a primer, a little basics of here's how loans work. And then the LE, the loan estimate disclosure, is the specific numbers and some estimated numbers of what that loan is going to be. involving. It's this. It's a buyer disclosure form the lender's given to the buyer. Here's what this loan looks like. Here's what you're expected to pay. There's another legislation or act involved that it's actually the acronym is TRID, TRID, and it stands for this, TILA RESPA, Information Disclosure. And so when you see TRID, it's like an acronym made of two different acronyms. TILA is the Truth in Lending Act, which says you've got to tell the truth in what you're loaning people. The lender's got to be truthful in the rate and all the various loan terms. The RESPA is the Real Estate Settlement Procedures Act that we've just been learning about. And so TRID means this and this have to be true and accurate. So TRID, because of TRID, TILA RESPA Information Disclosure, sorry, not that. Disclosure. It's the thing that says the loan estimate is due 3 days from loan application, and then fast forward to closing day. It goes to within 3 days of closing, the CD has to be provided. So we've got our loan application day. Within 3 days of that, the LE is due. And then we have our closing day way out here. And within 3 days before closing, the closing disclosure is due. And so we already saw the LE. I'll show you tomorrow the closing disclosure. And they look pretty much exactly the same. Some of the numbers on the LE were just estimates because the lender's not going to 100% know every single thing, but it better be pretty darn close. They can't make this ridiculous estimate that's out of control. And so those two things are involved because of TILA RESPA information disclosure. You got to provide the loan estimate within 3 days of the loan application, and the closing disclosure no sooner than 3 days before the closing. And who is that applying to? The lender. That's on the lender. That's not on us as brokers. We might ask, hey, did you get those things? But it's not our responsibility to provide them. That's for lender stuff. Here's what is disclosed. There are 3 different buckets. One bucket of things that the lender is required to disclose accurately is whatever they charge, that they have control of. So one thing the lender has full control and can decide what they charge is that thing we learned earlier called an origination fee. That's a straight up lender fee, and it's up to them to charge 1% or 0.5% or 2%. And so they better tell you the truth now compared to when they actually charge it to you on closing day. They have zero tolerance for lender related fees because the lender has full control over what they charge. So that bucket better not deviate at all between the loan estimate and the closing disclosure. If the amount for origination fee, for instance, goes higher than what you were promised on your loan estimate, the lender's got to pay it themselves. They have to absorb it because they promised it to you. And again, they have control over those certain things. There's another batch of fees that the lender gives the borrower a list to pick from. So the lender's kind of saying, here's what you could pick. And if that goes more than 10% over what the lender promises, then the lender has to pay for that amount over 10% that it went. So it's to keep the lender in check because the lenders abused these things once upon a time. There's a third bucket, and that bucket in a transaction would be like a inspection. The buyer has the right to do a termite inspection, a regular home inspection. The lender has nothing to do with who the buyer chooses to do those things. And so is it fair to ask the lender to pay something if those amounts turn out to be more expensive? No. So they don't. They're not required. That's a no limit bucket, meaning the borrower can choose the $1,000 inspector or the $500 inspection, but the lender doesn't have to pay either way, or all they're going to say is you should probably have an inspection. And if they put on the loan estimate that the inspection is going to be approximately $600, but it turns out to be $1,000, they are not required to pay for that difference. Because again, it's totally 100% up to the borrower's choice who they hire for those things, as opposed to the lender being involved there. So those are the three buckets, and we also saw them on that loan estimate. Let me see if I can pull that up before we say goodbye till tomorrow. There we go. If not, I'll get it pulled up for you for tomorrow. Well, here it is. It's page 2. And so this says the loan related costs. Again, things the lenders can charge, like origination fee or discount points or application fee. Services you cannot shop for, like appraisal, credit report, that's the 10% category. And then services you can shop for, like various inspections and things that you could have a say-so in, and therefore the lender's not required to pay for anything over the estimated amounts for these sorts of things. What we're looking at here is actually more of a closing disclosure. But with that, we're going to dig more into this topic tomorrow. We'll be getting into some math tomorrow. So bring your pencils and your calculator, and I'll see you then. Have a great night.